Okay. The beauty of Zoom is that it allows people to come into the room, and I don't like to do my whole spiel before everybody gets into the room. So I'll keep my words to a minimum right now. But yeah, we always have people sign up. It's always funny how many more people sign up than attend, but that's life of a free event. That's what I've learned in the past. Um, but so everybody should know this meeting is recorded. The beauty of this event is, again, free is great. But of course, if you can't stay the whole 5 hours each day, the beauty of it, it's going to be available on YouTube forever. My name is Ari Rosenbaum. I'm an ERISA attorney and I play one on TV, I think. Welcome to that 4K National Virtual Conference. I'm going to speak for a few minutes because, I do these events not just out of the kindness of my heart, but also to promote myself. Um, but that National 401k, that 401k National Virtual Conference came out of an event I did in 2020. I was still doing to this day that 401k conference around the country, MLB ballparks. Behind me is the event that we're doing in April in Chicago, and we're doing one in May in Colorado. And I was doing a whole bunch of them in 2019. And then I said, well, why don't we do a national event at Disney World? And that's a great excuse for me to go to Disney World and have an event there and whatnot. Uh, it all looked good on pen and paper. And then life throws you a curveball. We had the event the week of COVID. Um, so I think the event was Monday, Tuesday, Wednesday. Uh, Wednesday night we leave, and the NBA, suspended their season. By Sunday, Disney was closed, and the whole world shut down. So I said to myself, that's the last time I'm ever going to do a national event. And needless to say, um, I'm not the only one who stopped doing national events. The business has changed. We all learned in this business that Zoom is a great substitute, and that's why I've been. This is the sixth year we've been doing this national virtual event. It's fun, it's entertaining, and for everybody, nobody has to get a hotel room and this and that and whatnot. But of course, like I said, I'm promoting my live events, Wrigley Field in April, May the 5th, Colorado. Hopefully get to Washington in September. Like I said, business has changed. I'm not doing 9 a year. It's down to 2 or 3 a year. And the other thing that I'm going to shill and promote, which is going to be part of my presentation at 2:30, is that 401k plan provider handbook. It's the fourth book I've done. And so that means that's the fourth book that people will ignore. But this is that one book that I finally wrote that had none of my personal baggage and just really kind of the insight that I've seen. I'm 53 years old. I've been doing this for more than half my life, working with TPA firms, working with law firms, and working on my own firm for the last 16 years. And the things I've seen and the mistakes that I've seen other people make, and even some of the mistakes that I've made. So it's almost 300 pages of, some good advice here and there. So it's available on Amazon, on Kindle and paperback. So hope you read that. And that's pretty much it. We got an agenda, and I guess this is part. My 15-minute talk only took 4 minutes, which is strange for me. I usually talk a lot longer. Our first presentation, and then after that we'll take a break because that's the way the schedule worked out. Brad's here from was it MUN CPAs or the
Yeah,
right?
Mun CPAs.
Oh,
Yeah.
so it's Munn CPAs, kind of like Olivia Munn.
Hmm.
Okay. I never,
Yeah.
when I see big letters, I think it's an acronym or something. So Brad's good friend was with me in Anaheim. Last year we had a nice event over there with Mark Langston, which is one of the few times that I ever asked for a guest, and Larry provided one for me. And that's the beauty of these events. For $100, advisors could attend 5 hours. They got lunch, and a meet and greet with a great. We're trying to line some up for Chicago. Last time we were in Chicago, we had Andre Dawson. I think Andre wants a little bit more money these days. But tune in, that401ksite.com, all the information on all our events. And Brad, going to talk about auditing, such a great topic, an important topic for anybody who's got an audit eligible plan. Brad, take it away.
All right. Thanks, Ari. Thanks for the great introduction. Well, good morning, everybody. I am Brad Bartels. I'm a partner with Munn CPAs in Sacramento, California. Probably one of the few places in the country that hasn't gotten hammered by these winter storms that are coming through. So we've been kind of lucky in that standpoint. But Ari was gracious enough to let me start off the conference having an auditor of plans talk to you. And I'm going to talk with you about kind of what are common audit findings that we find, or what DOL audits find. What are the typical causes, and just what are some remedies and recommendations that I can give you, so you can talk to your clients and give them some recommendations to try to get ahead of the curve if you have an audited plan. Some of these will even apply to smaller plans that don't require an audit. So it would be, best practices for those plans as well. So I've got, let me share my screen here with a little presentation for y'all. And we'll just go through this. And then Ari said after this will be a break, and usually after the auditor talks, most people need a break to recover from all the lingo we throw at you. So the timing is probably pretty good with that. So let's go and get into it. So I've kind of got three sections. So I've got it broken into common audit findings, kind of things that are pretty typical, the low-hanging fruit, if you will, that we'll go through. Then I've got some other noted findings that aren't quite as common, and then some what I would call less frequent, but still pretty important ones that we come across every so often. So let's go and get into it here. So common audit findings. I found some interesting quotes related to it. Common audit findings, people just keep making the same mistakes over and over and over again, but they're consistent in it. So if people want to be consistently wrong, they can be consistent, but we want to keep getting into it. So the low-hanging fruits. So the one everybody's probably knows about, the late remittances, the employee deferrals. Couple of different ways to look at it. If you're a small plan, so you're not an audited plan, and you file that 5500 SF form, you have a 7-day safe harbor. So you have 7 business days to remit that money to the custodian, and as long as you do it within 7 business days, you're safe. Large plans are a little bit differently. So if you file the 5500 large form, which means you're an audited plan, the DOL says you need to remit that money as soon as administratively feasible. Now, what does that mean? That really means that as the plan sponsor, you set the standards. So if you can do it in 2 days, that's the bar that you've set, and you've got to meet that every time. So if you've shown consistently that you can take you 2 days to remit that money, and all of a sudden one time it takes you 5 days, well, the DOL could technically consider that a late remittance, even though it took you only 5 business days, because you've shown you can do it in 2 days. So the Department of Labor really almost has no valid excuses to kind of get out of that late remittance, jail, if you will. Really, one of the rare ones that I see works is if there's a blackout period. If you're changing custodians and you have to stop remitting money to one custodian while the new one's setting it up, they will give a little bit of a grace period for that. But other than that, they really have no valid excuses for why something would be considered late. Typical causes that we see for this. A really common one is if you have a manual process for doing your payroll and remitting the money to the custodian versus an automated process where maybe you use a bundled provider, you use ADP or Paychex, and they just automatically remit the money. That typically is rarely an issue for a late remittance. But if it's a manual one where the plan sponsor is responsible for sending the money, often and not, that's where we find issues there. A key employee will terminate employment and leave the plan sponsor, and then no one really knows how that employee was doing it. There was no instructions left behind. Everyone's kind of confused because someone left. And so a lot of times that's when something will go late. Or a key employee is out on a medical leave or out sick or on vacation, and money doesn't get set in timely. So that's another typical cause. Another one we see is if there's just no documented procedures for how the company's supposed to run payroll, and remit the money. So again, an employee leaves and there's not a list of someone can step in and just follow a set of instructions. So those are probably the typical causes we see for what causes a late remittance. Simple remedies, I would say use a payroll provider. These days, your ADPs, your paychecks, whatever, it's so automated that they have that money usually remitted, if not the day of the payroll, but the day 1 day after. And usually when we do our audits and there's an automated payroll provider, it's very consistent 1 day, 1 day, 1 day, 1 day, and there's no issues there. In the absence of that, I would say have your plan sponsors and your clients set up processes for how to do it that are somewhere where someone can easily find. So if someone goes on vacation or someone terminates employment, whoever steps in to fill the gap can follow the steps and know how to do it timely. All right. The next common one that we see a lot of times is definition of compensation errors, where the payroll system is using the wrong compensation in order to calculate the deferrals and possibly other employer matching contributions or profit sharing contributions that then get sent off. This can occur in large plans or small plans, plans that have been audited year after year, or plans that have been audited for the first time. It's interesting. There's really no rhyme or reason for how this happens. Excuse me. I've audited plans for 4 or 5 years with no issues. Then all of a sudden, 1 year, there's all kinds of problems with compensation. So it's really interesting how these compensation errors show up. Typically, we find this when we are doing our testing of employee deferrals. So we'll pick an employee and get his salary and recalculate it and figure out, hey, this employee made $100,000, elected a 10% deferral rate. So we think we should see $10,000 go into their 401k plan account. But then we recalculate it and a different amount is going in. So what's going on is that your plan document defines what is eligible compensation for various forms of deferrals and other forms of contributions. But something happens and the payroll system gets out of whack with what the plan document definition is. Let's give an example here. So let's say it's pretty common for the plan document to define eligible compensation as all W-2 wages. That's a pretty all-encompassing definition of eligible compensation. There's no exclusions. It's just straightforward all W-2 wages. But what we'll find is that a pretty common one is that bonuses have been excluded from the calculation of deferrals and employer matching contributions and whatnot. If the company runs an off-cycle payroll for whatever reason for an employee, they won't include deferrals on that off-cycle payroll check. It'll get overlooked and not included. Sometimes some companies will do PTO payouts. An employee has grown their vacation balance so high that the company says, here, we'll just pay you out. Similar to an off-cycle payroll, the 401k deferrals are not included on that off-cycle or that PTO payout. And sometimes we just see that other forms of what are W-2 compensation have just been excluded from the calculation for whatever reason. I don't know. There's a number of reasons this happens, but the result of this is typically that the plan sponsor will need to make corrective contributions to make up for the errors. And so that's an additional cost to the plan sponsor to make the employees whole. This can, result in additional costs to the plan sponsor. It also results in delays in the audit if we're running an audit, because we only look at a sample of employees. And if we find errors in the 5 or 6 employees that we're looking at, we'll have to ask the plan sponsor to go back and look at every employee to look for that error to see what the total dollar amount of the problem is and what the correction needs to be. So that can result in delays in getting the audit done and filing the 5500 and whatnot. If the Department of Labor audits a plan and they find these types of errors, they can go back 3 years and look for those issues. So it could really be a mess if you have a DOL audit and they find these types of issues. They can really start digging and going back. So you really don't want to get set up in this. Typical causes for this. These are the common ones we see. A new pay code might be set up in the payroll system, but the pay code isn't set up properly. They forget to click a button that defines that this pay code is eligible for 401k deferrals, and no one caught it, so there's an error there. The plan document could be restated, and this happens occasionally. But the problem is the restated plan document doesn't have the same eligible compensation as what was previously being used. And the plan sponsor is unaware because they didn't really take a close look at this restated document. And so now the payroll system is calculating deferrals based on the old definition of eligible compensation, not what the plan document says. As auditors, and if the DOL looks at it, we have to go with what the current plan document says. And so there can be issues there. A change in payroll providers are pretty common where this issue happens. The new payroll provider, everything switches over, but pay codes aren't set up properly. No one looked at it to make sure it was right. So there's another common issue. And then there's the old, we've always done it this way excuse. We'll get a new audit client and we'll immediately find that there's compensation issues between what the payroll system's using and what the plan document says. And the plan sponsor says, well, we've always done it this way. Well, that doesn't make it right. I mean, just because you've always driven 70 on the freeway and the freeway speed limit's 55, that doesn't mean it's always right. So, police officers are going to give you that excuse. So, those are the typical causes we see for where this happens. Remedies, things to fix it. Make sure you're looking at your payroll system at least once a year. Just have a look, have a check, and make sure the right boxes are checked. Make sure it's set up the way that you think it should be set up. Strange things happen in computer programs and buttons get unchecked for unknown reasons. So you just go through and look at it and make sure that it agrees to what it should be. If you are inputting changes into your payroll system, make sure a second person's looking at it. A second set of eyes often catches things that are overlooked. A little box isn't checked, whatnot. So just make sure someone's looking at it, a second set of eyes, if you're doing wholesale changes in your payroll system. And then if you do restate your plan document, make sure you're looking at it. Someone's looking at it, maybe two people look at it, make sure that the right boxes are checked, and make sure that it's meeting your expectations of what eligible compensation, as well as any other important sections in that plan document. Make sure the plan's operating the way you think it should be operated. So those are two big ones there, or late deferrals and compensation issues. Another big one that we see is that when we'll get in and we'll be looking at a plan and we're asking about the minutes from the meetings of the oversight committee, who's watching the plan and who's monitoring it. And the plan sponsor will say, well, we don't have minutes. We don't have a committee that's overlooking the plan. Well, this is kind of a big one. The Department of Labor, they really want plan sponsors to be monitoring the plan, exercising their fiduciary oversight of the plan, making sure they're taking care of the participants and monitoring the plan, keeping the best interests of the participants in mind. And the best way to document that you're doing this is keeping meeting minutes from a lack of a better term, the oversight committee that is designated for the monitoring of the plan. This can also be kind of a CYA, if you will. If your plan ever goes to litigation, you can at least show that, hey, we're meeting on the plan and we're monitoring it. Here's what we're doing. So not only from a Department of Labor standpoint, but from a litigation standpoint, which we know there's plenty of litigation in the retirement plan industry right now. So you want to keep those minutes to do that. So really, causes, as I mentioned, the plan sponsor just doesn't have a formal committee that meets on a regular basis and has designated people to work on it. Or the plan sponsor has a committee and maybe they meet once a year, maybe they meet twice a year, but it's very informal. They don't keep any documented evidence that they're keeping minutes. From an auditor standpoint, we always have to say if it's not documented, it didn't happen. So we have to say, well, we don't know that you're meeting because you didn't keep any meeting minutes. So this one's a really easy one, remedies. If you don't have an oversight committee, have them form one. It doesn't have to be large. It doesn't have to be 10 or 15 people. It just needs to be a couple of key employees at the plan sponsor who are knowledgeable of the plan. Typically HR is pretty knowledgeable of the plan, but they're not accounting related. So I always say you want someone from HR and you want someone from finance. And then typically it's maybe your plan advisor should be involved in that because they're typically giving the investment reports, a couple times a year. And anyone else knowledgeable to be part of that plan. And then you want to keep meeting minutes. You want to keep documented minutes to show here's what you're reviewing, here's decisions you made, here's things you reviewed. It'll document that you're keeping your fiduciary oversight of the plan. If you're looking, the question might be, well, what do I document in those meeting minutes? Excuse me. If you're looking for some tips on it, I did write an article and publish it on LinkedIn. So if you look me up on LinkedIn, you can look at the articles that I wrote and just look for that one about keeping 401k committee meeting minutes. There's some good tips in there. If you've got more questions, I've got a really kind of comprehensive list that I could send you. Here's really the details to keep in minutes. And I always recommend to meet quarterly. That's you don't have to meet any more often than that. Quarterly, that's when the investment reports come out. So that's the best I can say. So good evidence there to make sure you're keeping your eye on the plan and overseeing it correctly. Another big one that we find in many of our audits is that there's no evidence that the plan sponsor is monitoring and doing effective oversight of the key service providers to the plan. What are the key service providers? Well, typically for a 401k plan, it is the custodian of your investments. So your Principal, Vanguard, Fidelity, the big ones where you've got the investments. And then it's going to be your payroll provider, your ADP or your Paychex or whatnot. Those are the big ones. And they're really important because they're processing thousands of transactions a day or a week or a month related to either payroll or retirement plan transactional processing. So, what's the problem here? Now we kind of blew by that slide there. So the problem is that there could be issues in the controls and the processes at those service providers for processing those transactions, which would potentially lead to errors getting into your participants' retirement plan accounts. And again, if you're not monitoring these service providers, these errors could go undetected. And then down the road, all of a sudden, if it's discovered somewhere, it could be very costly to make corrective contributions, to make the participants whole, to backtrack and redo account balances and whatnot. So really need to monitor these. It can be very costly and time consuming to correct these. So what's going on here? So really, again, kind of this goes back to the plan oversight committee. No one at the plan sponsor has been tasked with monitoring the service providers and making sure they're doing the right job and making sure there's no issues. And the other thing is that maybe there is a retirement plan committee. Maybe they are meeting on a quarterly basis, doing everything right. But the plan sponsor just wasn't educated on what their responsibilities are for monitoring these service providers and keeping an eye on them. DOL really wants plan sponsors to be monitoring these. Most of the service providers will issue what is called a SOC 1 report. And the key one is a SOC 1 Type 2 report. And what this is another CPA firm will go to the service provider and they will do tests of the controls specifically related to either retirement plan transaction processing, excuse me, or payroll transaction processing. They will then issue a report of their work and their findings, and this is the SOC 1 report, and they will provide that to the service provider. The service provider should then be providing it to all their customers, all their clients, anyone who uses them. Plan sponsor needs to read these SOC reports and look to see if, number one, if it's a clean opinion, there'll actually be an opinion on it, or if there is a qualified opinion, which means there were some major issues in there. What's going on? What were the issues found? What are the deficiencies in the processes and the controls? And is that impacting their particular plan and their participants? And do they need to do additional research and issues? I'll share a war story with you. A number of years ago, there was a service provider who had problems with calculating the vesting percentages for distributions out of the accounts. And we found it when we were looking at the plan and doing our distribution testing. We were discovering differences in the vesting calculations between what we calculated and what the money was that a couple of participants got. At the same time, one of our staff was reviewing the SOC report and found that there was errors, noted in the SOC report for distributions. We went to the plan sponsor and they were unaware. They hadn't read it. They did not know about it, about the problems. So we needed the plan sponsor. We said, hey, we need you to look at all the distributions that came out of the plan during the year, and you do your own recalculation of the vesting and see if there are other issues. And they went back and found a number of other problems in addition to the couple that we found. And it pretty much led to a big mess. They had the plan sponsor, I think, had to end up putting more money into the plan to make the plan whole, because I think participants were getting more money. They were getting more money vested than what they actually were. But like I said, if they found this earlier on, it probably could have saved them a little bit of money. So kind of a war story of what happens there. So really, the remedies are make sure that you're educating your clients, your plan sponsors on what the SOC 1 reports are. Make sure they're obtaining them at the end of the year as part of their oversight of the plan. Make sure they're reading and reviewing that SOC report and documenting it in the meeting minutes. If there are issues noted, they also need to include what they did to make sure there was no problems with their plan related to that particular issue. I do have a SOC 1 review template that I can provide to you and give to your clients. So if you're interested in getting that, send me a message, look me up on LinkedIn, send me an email, whatnot. I'm happy to share it because I really want everyone to make sure that they're reviewing their plan and making it work and making it the right way. All right. So those are the common issues that we found. Those are the ones that pretty much every year we find those on a lot of our audits. It's pretty crazy how many we see. So now I want to get into some other issues where correctness could be spotty, it could be unpredictable, but when it is there, it's really good. But these are just things that we find maybe less often than those first couple, but they're out there quite a bit. I want to talk about kind of payroll controls, and payroll is a big deal for a retirement plan audit because payroll directly impacts how money gets deferred and gets into the retirement plan. So as part of our audits, we're looking at what are the internal controls around the payroll cycle. Does the plan sponsor have effective controls and reviews and approvals for key events and transactions to make sure that key data is getting into the payroll system correctly, changes to the payroll system are being done correctly, and the data coming out is in good shape? Typical causes or issues in the payroll system are there's a lack of a documentation of a review and approval for things like new hires. When a new hire comes in, is there review and approval for it? There's no evidence that it's been reviewed and approved for this employee to be hired. So are they really an employee? Pay rate changes and other data changes in the payroll system. There's typically not a review or approval process for inputting pay rate changes in the payroll system and reviewing and approving those changes to make sure they're put in correctly. Termination. So when an employee terminates, they leave, whether they retire or they're fired or for whatever reason they leave, there's no process to make sure that employee is correctly removed from the payroll system. So an extra paycheck doesn't, inadvertently go out to someone that doesn't work for you anymore. So those are real causes of errors that we see in payroll systems because no one's checking to make sure data is input correctly. As you might guess, the remedies for that are pretty straightforward. As I said before, as an auditor, if it's not documented, then it didn't happen. So we like to see that there's evidence that someone's reviewing and approving a new hire. So, an offer letter that's been reviewed and approved by a key departmental or owner of the company. When pay rate changes are approved, someone's given a raise. There's an evidence of a review and approval in the employee file for that pay rate change. And when that pay rate change is input into the payroll system, someone has looked at it to make sure that $25 is put in correctly and not 26 or 27 or something like that, or $2.50. So to make sure there's evidence of the review and approval of that, as well as terminations. When someone leaves the company, that there's a termination checklist that someone's reviewed and approved to make sure that employee was checked as inactive in the payroll system. So seems pretty simple, but you'd be surprised at how many companies don't have anyone looking at that for a secondary look on that. Something that's kind of hot in the issue is, pardon me, I got a little mixed up here. Forfeitures. We all know there's been a lot of litigation, kind of a hot topic around the use of forfeitures. Participants, suing plan sponsors for how those things are used. Seems like recent court cases are favoring the plan sponsors, but you never know what might happen down the road. But something that we typically see in audits a lot of times is that the forfeiture account is just growing every year if the plan does have forfeitures, and the forfeitures don't come out and are not used on a consistent basis every year. Most plan documents allow for forfeitures to be used either to pay plan expenses or to reduce employer matching or profit sharing contributions that way. But the problem is that those are used every year, and the Department of Labor doesn't want that forfeiture account to just grow and grow and grow. They want that money to be allocated and used in the right way. So what's going on with that? We really see that the plan sponsor just isn't aware that they need to be looking at it, or it's a combination of the TPA, the plan advisor, or whoever else just are not monitoring that account and not looking at it as part of the year-end close process. So it just grows. And it can get to be a fairly sizable number. We've seen forfeiture accounts almost $1 million. It's been crazy how big they get sometimes and don't get used. So a very key remedy here, pretty simple, just as part of the year-end close process of the plan, make sure that that forfeiture account is being looked at, and make sure that it's being used, and show that there are forfeitures coming out for the correct reasons. Not every year a plan sponsor has a matching or an employer contribution that can be used to reduce it. And so maybe you're using it to pay some expenses. Maybe you're paying, the legal fees. Maybe the audit fees are coming out of there. Maybe other fees. But if you paid the fees, the plan expenses, there's no matching contribution to offset, and you still got money in there. Consider just sending the money out and allocating it to the rest of the participants, just to show that you're using those forfeitures and they're going out, just so that in the very slim chance that the DOL comes knocking on your door, you don't just have this big cookie jar sitting there growing and growing, and you don't want to give them any more reason to dig deeper into your plan. So make sure those are being used. The SAS 136 misunderstanding. So this is related to an audit standard that came out back in 2021. It's interesting because SAS stands for Statement on Auditing Standards, but it's actually a requirement that more falls on the plan sponsors to do things. And as an auditor, we just need to make sure that the plan sponsor is doing these things. This really only impacts large plan audits. So if you work with small plans, you can kind of sit back and take a breath for a minute. This doesn't impact small plans. So it's only plans that are being audited. As I said, even though this is an audit standard, it really impacts what plan sponsors need to do. And what this requires is there's 4 key things that it requires plan sponsors to do and monitor for a plan. And what's interesting is it's really things that plan sponsors should have been doing all along. But prior to 2021, it was really mostly auditors were just kind of doing it for them and making sure this happened. But now it's putting more onus on the plan sponsors, showing documentation that they're doing it. So there's 4 bullet points there. So number one, they want the plan sponsor to maintain a current plan document and all amendments, which in many cases they were, but in many cases they didn't have it on them. It was somewhere at their TPA or advisor had it. But this requirement wants a plan sponsor to have that plan document in their possession. It wants the plan sponsor to take responsibility that an ERISA Section 103A3C audit is appropriate. Now, that Section 103A3C audit, that is what used to be known as a Department of Labor limited scope audit, where we get that certification statement. Most audits are what used to be limited scope. Now we just call it an A3C or a 103 audit for short. But this new standard puts the onus on the plan sponsor to take that responsibility to determine if this type of audit is appropriate. So it makes the plan sponsor have to understand, what is the certification statement? Is it coming from an appropriate person or entity that can issue that certification? And so we have to document that they have that understanding. Plan sponsor has to determine that the plan is operating in accordance with ERISA and the plan document requirements. And so what does that really mean? Well, the plan sponsor has to show us that they show that all the participants are whole, the money's going in the plan the right way, the payroll system's operating in the correct way. So it really puts a lot more focus on the internal controls of how the plan operates, and that the plan sponsor understands how it works. And then the last bullet point was kind of an easy one, giving us, the auditor, a substantially complete 5,500 before we can issue the final audit. That was really already happening in most cases, but it's just documented that it was happening. But what we are finding is that when we get a new audit client from somewhere else, if the plan had previously been audited, it seems like the plan sponsor just doesn't understand these requirements. And I don't know if other CPA firms aren't educating their clients on these new standards, or if they're just doing it themselves and documenting it. I really don't know the answer to that. I can only speak to what we're doing. We're really trying to educate our clients on what their responsibilities are under the SAS 136. We have a couple of different ways we do this when we do it. So during the audit, we come together and I've developed a SAS 136 checklist. Shockingly, another checklist that an auditor comes together and creates. But what this is, it just walks through as part of the getting ready for the audit. What's the plan sponsor's requirements under 136? What do they need to document that they've done, and how can they show us as their auditor that they've met those 4 bullet points there? So again, if you would like a checklist like this to provide to your clients, I'm very happy to share it. Again, just hit me up on LinkedIn or send me an email. I'm very happy to share it and then talk with you further about how it works. But from what I've seen, it's really educated our clients on what their responsibilities are under this and how it works, because it's kind of a mystery still. Like, you mean, this is an auditing standard, but it's I have to do stuff for it, and it's kind of like, yeah. But I think after a few years, our clients understand what they need to do, and it's really not that difficult once they go through this checklist once and really understand it. Some less frequently noted findings. So, you might be 99% right, but you're still 1% wrong. So these are ones we see occasionally, but just wanted to throw them out there. It's just as things we see. Sometimes if a plan allows loans to the participants, pretty much those always work pretty right. The loan's issued, the payroll system's set up right, the loan payments are coming out. There's really no repayment issues. But sometimes we'll see that a loan balance isn't changing, or something's not right with it. And we'll talk to the plan sponsor, and they really didn't realize that there was a problem. They didn't know that the loan payments aren't being made because everything's automated, right? It should all be working. But the loan balance isn't changing. Something's not working. Well, the typical reason for that is there is a change in a payroll provider, and that new payroll provider wasn't provided with the loan repayment details that the other former payroll provider had. And so now we've got to report delinquent loans on the audit and the 5,500. And the plan sponsor's got to go back to the participants and say, hey, we didn't take money out of your account for these loans. And it kind of creates a big mess. So that's really the most common thing we see when there are loan issues, is that for some reason payments stop when there's a payroll provider change. I also have seen it when there has been a change in custodian, and there's confusion on, there's loans in the old custodian. Is the new custodian taking the loans or not? If they port over to the new custodian, is the payment information sent over properly? I think that's less common than a payroll provider change. So just keep that in mind. If you have a client that changes payroll systems, you might want to ask them if the loan repayment information came over clearly. Some other things we might find are eligibility errors. Part of the audits, we're looking to make sure that the employees who are eligible are correctly in the plan and participating, and the employees who are not eligible for whatever reason are correctly not in the plan and not receiving those benefits because they're not eligible. We don't see a lot of eligibility issues, but what's been popping up is kind of the part-time eligibility things. So when Secure 2.0 came out and put that in for part-time employees to be eligible, we've seen a few plan sponsors who haven't tracked that very well. And so we've picked part-time employees that, based on their tenure with the company and the timeline, have been informed of their eligibility and participating, and it got overlooked. It wasn't put in. Plan sponsors just didn't have good ways to track part-time employees to let them know, hey, you are eligible now. So that is one kind of thing we see is related to part-time employees not being informed. So most companies have part-time employees. So if you're talking to your clients, ask them how they're tracking them to make sure they're meeting the new eligibility requirements. One other thing about eligibility that we see from an audit thing, and again, I mentioned that if it's not documented, it didn't happen, is back when I started auditing 100 years ago, everything was still in paper. And so when we would ask about employee eligibility and have they been informed about the plan, everything was in paper. So it was in their personnel file. The employee signed a paper form that said, I wish to participate and I want to defer 10%, or they check a box that says, I don't want to participate. And we could see that evidence. Well, now with everything being electronic, it's a lot more difficult to see that. It's pretty common for a company hires an employee and they say, hey, great, when you want to sign up for the 401k plan, here's the link. You go to it, you sign it up, and that's it. But as auditors, we need to know that these employees are being informed about the plan and their eligibility. And so, one thing that we always recommend to our plan sponsors is you need to at least show us evidence that you're informing your employees about the plan and when they're eligible. And then it's up to them to go sign up, and we get that. But either some sort of an email correspondence that we can look at, some sort of a new hire checklist that shows, hey, 401k plan information was provided to Joe Smith, check, signed off, just something that we can see. Otherwise, we're going to have to put an audit finding that says you're not informing your employees about the plan because we can't see it. So that's probably kind of pretty common finding is just lack of evidence of audit evidence that you're showing the employees that. And I think that's everything I got for you. So I'll leave that up there for just a second. If you have your phone and you scan that QR code there, it'll bring up my contact information for you, give you a chance to reach out to me if you got any questions.
Yeah,
I really
somebody asked
appreciate.
about if you can provide the presentation slides, and I'm
I
sure.
absolutely can. So
Yeah.
reach out to me. I'm more than happy to share this. It's there's nothing secret or proprietary in it. So hit me up and I will be more than happy to share the slides with you. Absolutely.
One of my favorite, yeah, you mentioned that, and I always talk out of school. There was an event in one of the stadium events, and somebody had slides, and they had to switch them out because they had proprietary stuff on it, and they realized the competition was in the room. So you should not, it's like I'm a big fan of never giving away the secret formula to Coke, so don't put it on your slides. But there are two questions,
Yeah,
both
nothing
from
proprietary there. Yep.
exactly. Exactly. We have two questions from our good friend Mike Webb. Number one, Brad, have late deposits trended downward over the years? I recall the 90s where it seemed like an epidemic. Nowadays, not so much. I got an
You
opinion
know,
on that.
I would say that, we got it anywhere from 60 to 70 plans in a year. And I'm going to say 30 to 40% of our audits have late remittances. It's really interesting that they're always just there. I wouldn't call it an epidemic, but to me it's surprising that it shows up as much as it does.
Well,
It's
I would
like I
say
said, it's the
that,
most common finding we have.
right, but back in the day, everybody got it in by the 15th day of the following month. It was really fairly easy, even with mail and all that kind of stuff.
Yeah.
And, electronically, I always say this, you never miss once. An employer does not miss once. They miss multiple times. It's like I'm still amazed by it. I drive by the old high school where my kids went, and there's always the same people, 10 minutes after school started, they're driving their kids to class. It's the same concept. They're
Yeah.
always late. And then Mike's got another question. Assuming you prefer a total compensation definition that does not exclude multiple pay codes, do you have a preference as to what type, which is W-2, the 3121W, or 415? Which do you prefer?
I don't prefer one or the other. We just want to make sure that whatever is selected, that's what's being used. Um, so as long as the plan sponsor understands what they want, and as long as they've got the payroll system set up for what the plan document says, it doesn't matter to us either way. There's it's whatever is right for each individual company and how they want to do it.
Okay. And then this is always a tough question. What is a typical audit cost, single and multiple employer? Because that's a difficult question to ask.
That is a difficult question. It,
Yeah.
it just varies by the number of participants, the plan assets. There's so many variables into that. I could talk one off if whoever asked that question wanted to reach out to me. I'd be happy to get more details that probably don't want to be
Yeah,
discussed
because there's
here.
a lot of moving, in audit, I charge a plain document, it's the same price it's always been for the last 27 years because whether it's, got 1,000 employees or five, my cost doesn't change. Your work changes on how many locations, how many employees, how many
Yeah,
adopting employers, it's not an exact science. Everybody's different. Everybody's going to get a different price. The parameters
exactly.
change. Fine.
Yeah. I
Okay.
appreciate being able to be here. I look forward to seeing you
Yeah.
in Denver.
Oh yes, Denver. And again, I got to push these events. The live events sponsorships start as low as $500. If you're DCIO, you want to say hi, have a 2, 3 minute elevator speech. You want to speak $1,500. That's the same price since 2018. That's just the nature of it. And of course, I always have to get the phone call during the I hate that iPhone connected to my Mac. But yeah, we'll see you May 5th. And then April, we'll be at Wrigley Field. And anybody interested in sponsoring, just reach out. It's a lot of fun. I always have fun, even though I'm a little bit nervous at the beginning. But I recommend anybody who's ever, any even if you don't have interest in baseball to attend these things. You learn a lot, and even the tours are pretty cool. So we're going to take 10-15 minute break. I'll be on a little bit before 11, and for the people who are watching this on YouTube, I'm going to kindly pause the video so you don't have to go through 15 minutes of a blank screen. Okay, thanks. Okay, great. We're recording. Yeah, we knew we were live. Don't worry, we didn't do anything wrong during this part. Somebody a good friend texted me. He's like, you're still live. I'm like, yeah,
It's great.
I know we're live. We didn't. It wasn't a hot mic yet, but we didn't do anything wrong. And
Yeah,
then was
right.
was Ari Rosenbaum of saying something really, really
Yeah,
bad.
we entertained them. It was like a comedy
No,
show
but
for a
this
few
day,
minutes.
this day and age, there's a lot of those hot mic, instances. What was that guy Greenfield on CNN or whatever? He was caught like during a Zoom meeting undressing or something. The legal
Oh
expert
my
had
God.
him.
Yeah, yeah.
Yeah, you always have to worry about a
We
Zoom.
didn't do that.
Yeah, but and thankfully we didn't record it. So yeah, it was not recorded anyway. But I'm back. And again, I always have to shield for my stuff. That 4kside.com, sign up for the events in Chicago and Denver. I will always mention that. And my book's available on Amazon and Kindle, that 401k Plan Provider Handbook. Full Circle still out, and some of the other books that, of course, nobody decided to buy, but here and there I get like $3 a book. So please help a friend out. So anyway, our next presentation, Mike and Matt from Brandywine. You can guys take it away.
All right. All right. Thank you. Um, Excellent to be here with everyone today. So let's jump right into it. All right. So, one sec. Mike, you see this all right?
I see it fine.
All right, let's jump into it. So today we're going to be talking about a couple key topics here. Um, and we're part of the Brandywine Asset Management team. I'm Matt Dever, and this is Mike Dever here as well, running operations. And to start, in the next 30 minutes that we have with you here today, we will absolutely be showing you something that you have never seen before.
Unless you're a Brandywine client.
Unless you're a Brandywine client.
Yeah.
The thing we'll be showing you is a process that demonstrates it can beat the benchmark while reducing risk at the same time. And it's going to be made available to you for the first time, unless
And just
you were in a qualified plan with Brandywine already.
yeah, just to clarify, the title of this presentation is Reduce Loss Equals Increased Return. So it's not that we're reducing loss at the same time we're outperforming. We're outperforming because we're reducing risk and loss in the portfolio. We'll show how that happens. It's a mathematical process.
Excellent. And this is available right now through only qualified plans. However, we are launching an ETF suite in the second quarter of this year, making it available to everyone. And at the end, we'll also show how you can get into the ETFs via a 351 exchange, which is a tax-free entry into the ETFs.
It's a one-time opportunity. It occurs essentially the day before the ETFs start trading. So it's something that we're talking with as many people as we can right now, because we don't want to be sitting here a month after they launch, hoping we had talked to someone then and we missed them.
Absolutely. Okay. So the process itself is called risk replacement. And the principle behind it is that reduced loss equals increased return. And before we explain how it works, let's just show you the results. And like we said, we're going to be showing you something you've never seen before, and the results are a testament to that. And the actual trading of Brandywine's 6 US equity funds that are all utilizing risk replacement, the benchmarks of those funds have returned around 18.5% since inception. Brandywine funds have returned 20.6%. So an average annual increase of about 2%.
And what I want to just point out here, Matthew, is that this generally you'll have some outperforming funds within a fund family, but across the entire suite, that just doesn't happen. And it certainly doesn't continue to happen over extended periods of time. And we're going to show you why this occurs rather than more random results that you see with active fund managers.
Correct. On top of that, the maximum drawdown of the benchmarks for these funds was around 23% loss, but Brandywine's funds constrained that to an average loss of 17.5%. So in addition to outperforming by 2%, we were able to reduce the average drawdown by about 25%. So quite impressive.
Yeah, again, I
To
want
say
to kind
the
of flip
least.
that statement, Matthew. It's
Yeah,
because we were able to reduce the loss by 25%, we're able to recover from higher levels
right.
and compound returns at a higher rate to outperform the benchmarks over time.
Exactly right. And one more fact just that leads to the performance numbers we were showing here. And Mike, to your point, it's because of the drawdown reductions that leads to the outperformance. And that's displayed by the capture ratios of these US equity funds, which is we've been able to maintain right around 100% upside capture ratio, but drawdowns are reduced to 58% in this situation.
And then the net here of over about 40% outperformance of the upside minus the capture, downside capture. If you look at funds that are considered elite, maybe they're 20%. So this is just dramatically different than the funds that are elite. And again, we'll go on to talk about how the process is a mathematical process. So it's not just based on picking, good stocks and the magic of stock selection or market timing, for example.
Exactly right. Okay. And because of these results, we have been getting some credit thrown our way. Intriguing by the Wall Street Journal, called Game Changer by the CEO of a leading advisory firm. And we've had a capital move into the CIT funds that have been directly replacing the passive and active index funds that these are designed to replace because they've been able to increase performance and do it with less risk.
And even before we started trading the funds, we had some of the advisors come to us and say, wow, I wouldn't be honoring my fiduciary responsibility if I did not consider Brandywine for my portfolio. And I think that's something that's significant to consider because now we actually have the multiple years of actual performance that's doing exactly what they were supposed to be doing.
That's right. So to jump into, so we've seen the results of this. Now let's jump into the problem that this was designed to address. Obviously, the end goal is to increase the capital in investors' pockets at the end of the day. But specifically, this was developed by Brandywine to address some fundamental issues with active and passive investing in general. And to highlight that, the problem is that active managers, 16%, are able to outperform over a 10-year period. 85% underperform their indices. And many of the people on this webinar might already know that. But what they might not know is that that percentage gets worse over time. If you give an active manager a longer runway, the likelihood that they outperform the index decreases. Specifically, over a 15-year period instead of a 10-year period, only 9% outperform their benchmarks.
And what I want to point out there is this is the behavior of gambling. So the longer you're sitting at the table, the higher your probability you're going to underperform. You're going to give money to the casino. You're going to lose money. And unfortunately, it starts already pretty poorly. Where over any 5-year period, you might have some minority of active managers outperform their benchmarks. You go to 10 years, now it's only 16% outperformance, and 15 years it's 9%. So the longer you play the game, the higher your probability you're going to underperform, which is why people go to passive investing.
And that's exactly right. So it's led investors to go to passive investing, but the downside there is you're obviously completely exposed to the market. And it can lead to dramatic periods like this, for example, where you have a completely flat decade, right? And we're hinting to it, but risk replacement is a solution for both of these things, underperforming active managers and um, periods like this. So a quick background on Brandywine then, Mike, you best served
Yeah,
to,
so
to address this, but
I founded Brandywine in the early 1980s after a few years of trading on my own. We had some really good success with our own trading, but also outside managers through the 1980s, like Paul Tudor Jones, for example, or John Henry, where we identified them and allocated capital to those managers. Then we pioneered what we call return driver based investing, which is sort of a core of what we're doing with risk replacement within that. And it's what I wrote about I had a bestseller in 2011. It was a #1 best-selling mutual fund book on the Kindle for more than a year, talking about return driver-based investing. We did that throughout the 90s, highly successfully. In 2020, we were approached by some people who said this would be a game changer for the retirement industry. And we launched some funds that initially were structured as hedge funds and then rolled out as CITs a couple years later. Now, here we are in 2026, and we're replicating exactly what we've been doing in the CIT suite with ETFs. So instead of being just available to qualified plans, we're making these funds available to everybody else.
okay, so we've seen the results. Let's explain what the process behind risk replacement actually is. And it is a three-step process. The first of which is we are designed to be a replacement for your index positions, both passive and active. And as part of that, the first thing in which we do is we buy 100% exposure to whatever index that risk replacement fund is designed to map.
And I want to repeat that. What he's saying is we're a replacement. So all the 401k plans that we've had come into our funds remap their existing exposure to one of our funds. So, for example, small cap fund that they currently have in their 401k plan gets remapped to Brandywine Small Cap, which is benchmarked to the Russell 2000 index. And we structurally created these in combination with a consulting firm that was initially seeding these funds to ensure that we had a 95 R-squared correlation to each of the underlying benchmarks. So these served cleanly as a replacement for those funds, not as an alternative in the portfolio.
And we'll show you some line charts as to how these trade relative to the index. They track very closely, hence the 95 R-squared there. We also have a point here, a bit of a jest, that just buying the index already puts you in the top 15% of managers, which we are an active manager shop, right? But we believe that, buying and holding is an excellent strategy. And these funds are designed to let you just buy and hold.
Right. Rather than hoping that the managers have some magic that allows them to pick the hot stocks, we're just following the math.
Okay, so we have 100% index exposure. What is the next step that we do? And that is we seek to directly mitigate losses. Typically, this is just through put options on the index that we already own. And as you can see by the chart here, this is the types of loss mitigation that you can expect from a fund utilizing risk replacement. Anywhere between a quarter to 50% of the losses for the CIT funds that we have, and also the same strategy will be applied to the ETF funds that we have. Okay, excellently. So those two parts explain roughly the capture ratios that we showed earlier, right? How you're able to have a 58% downside capture if you're able to directly mitigate losses. That's explanatory. And I'll also add here that these mitigation strategies are 100% on all the time. Brandywine does not engage in market timing activities. We are a systematic shop that holds the same proportion of these three components all the time. But The third step to this is how do you pay for the put options when they are expiring worthless during a bull market, which is exactly what Brandywine's funds have seen since inception, and yet we've still been able to outperform. The only way to do that is if you can pay for the put options. And that's where the third piece that we call the return driver diversifier. And this can be thought of as the same way any advisor tries to diversify their return stream by buying additional asset classes, commodities, gold, bonds, rate strategies, other funds, right? It's just trying to add a separate return stream that pays for the puts. And the reason why we put this return stream directly into the fund is because it allows us to customize the return driver to perfectly match the index, and to not be correlated to the index and not be correlated to the put options.
Yeah, so the reason we end up calling this risk replacement is because what we've done is we've got 100% exposure to the underlying benchmark for each of our funds, and we offset a portion of that risk with that downside protection, the put protection. And then we replace some of that risk that we offset with the return driver diversifier. And the return driver diversifier is totally uncorrelated to the underlying benchmark. And we only need to earn a couple percent a year to pay for the cost of the puts. So the risk in the return driver diversifier, it's also more broadly diversified than just the underlying benchmarks. So the risk in the diversifier is about 1/4 the risk that there is in the underlying benchmark. So we replace the high risk of the benchmark with the lower risk of the return driver diversifier, maintaining protection on it the entire time.
So we'll just run through it one more time, just high level, but every fund utilizing risk replacement follows the same steps. The first two steps will change depending on the index we want to track. Large cap, for example, will be Russell 1000, small cap Russell 2000, but it's the same three principles. It's 100% exposure to the index that we want to track. It's put options or a similar strategy to protect against those losses systematically, always on. And then it's the return driver diversifier piece that is designed to pay for the 2.5%-ish cost of the protection. And you do put those three pieces together, and you can get close to 100% upside capture with around a 60% downside capture. So that's it. That's the three parts. Let's see how this actually trades. And this is hypothetical performance showing a severe scenario in which risk replacement really pays off. We were not trading the funds in the decade between 2000 and 2010. However, if you remember the chart we showed earlier, it was actually the same chart without the purple line on it. It's passive investing leaves you exposed, right, to periods like the double bear market, 2000, 2010. A fund utilizing risk replacement was able to turn that lost decade into around an 8% annualized performance, which is pretty incredible to see. And a lot of that comes from reduced loss equals increased returns. That first 2 years there, where the market dropped 51%, risk replacement was able to mitigate that loss to just 33% because of the systematic protection we have in place. And because of that, we've been able to start from a much higher base, and exit out of that decade significantly higher than where the passive index was.
Yeah, just the math on it there, Matthew. So if you have a 50% loss, obviously you need 100% recovery to get back to even. If you're down 30% instead of 50, that same 100% recovery takes you into 40% new high territory already. And that's what you see happening here, is that you continually compound from higher levels, and over time you end up with a bull market performance throughout a bear market decade. We like to say it's like starting the 100-meter race on the 30-meter line. You're getting the head start following the bear market. This is the primary reason we developed risk replacement, is for these types of scenarios, to protect people, mitigate risk in bear markets, recover from the higher levels. But what you also see next is there's another advantage to what it is we're doing.
So of course, always on put protection will protect during a bear market, but it's been able to outperform during a bull market as well. And that's because of what we can describe as some volatility capture, more or less. We've been able to successfully move ahead of the benchmark during periods of even moderate volatility. And that is referenced perfectly well about the middle of that line graph there, the start of 2025 during the tariff tantrums when the market dropped 19%. Risk replacement fund dropped 11.7%. So the same type of protection you saw on the last slide.
But what happens here,
It
and this is
applies
the
in
interesting
smaller
thing,
periods. Yeah.
it did mitigate the loss, but we didn't actually ever cash in the puts. Again, the systematic process we had was waiting for those puts to create value and to be expired and cash in at that point. That didn't happen because the recovery happened so quickly here. What did happen, and what reason we can refer to this like a volatility capture, is an automatic dollar cost averaging. When the Russell 2000 in this case was down 19% at the trough, the fund was only down 12% approximately. That means that the Russell 2000 benchmark was underrepresented in the fund by 7%. The fund was required to have that 100% exposure to that. Buying then, as that market dropped, the Russell 2000 at a discount. Ultimately then, when the benchmark came back to just break even, the fund was up a couple percent additionally because of that dollar cost averaging that it does just as an automated process, even though it didn't cash in the puts. So it's really interesting that we've had a period over the last 3 years where these funds have outperformed by the numbers Matthew was showing previously, more than 2% annualized with 25% less risk, even without the benefit of a big bear market and being able to cash in the value of puts, just because of the natural math behind the dollar cost averaging that's embedded in the structure.
Okay, so up until now, risk replacement has only been available to CIT candidates. These are qualified plans, 401ks primarily. However, in the second quarter of this year, we are launching an ETF suite, and these will be the funds made available. So unorthodox to most ETF launches, we're doing 9 ETFs at the same time. We were told that most people launch 1 or 2 at a time, but we have a strategy that works. And we see no reason why we shouldn't launch every fund out there.
Yeah, well, you'll see. People know this. There's these thematic ETF launches. A market's hot. It's crypto. It's whatever it might be. It's AI, and so a fund is launched at that time to suck up that demand. Sometimes they have a period where they might outperform, but as we showed previously, over a long term, your odds are against you with those funds. Brandywine is following a mathematical process. This mathematical process isn't dependent on manager skill or a specific asset class expertise. It's based on reduced loss equals increased returns. So when we're launching the ETFs, we're launching it across the entire suite, making it available to everybody.
Okay, in addition to that, we said that we would give an opportunity for a tax-free entry into the ETFs. That is what's called a 351 exchange. And it's perfect for investors that have unrealized capital gains and are in moderately concentrated portfolios, even diversified, actually, if they still want the protection, which they should.
Yeah, we have investors coming in that have SPY exposure, for example, because of the second bullet point.
Right. Diversified portfolios that need downside protection and the ability to outperform over time as well.
Yeah, they've accumulated these huge capital gains. They don't want to give them back, but they don't want to sell, incur tax, and give up the upside opportunity. The 351 exchange into Brandywine funds allow them to retain both the original cash basis, they're not paying any tax, and 100% upside exposure to their selected benchmark.
So we're having conversations every day with advisors that have, and I assume the majority of people on this call either personally or have clients with heavily embedded unrealized capital gains. This is an excellent way to diversify out of that without having to sell those positions. And the way it works is fairly straightforward. The day before the ETFs go live, you contribute your portfolio, and the next day you receive an equivalent dollar balance in the ETF of your choosing. And These are the ETFs that you have to choose from. We have the same as our CIT enhanced funds. It's US blend, US equity value, US equity growth, as well as international equity and 2 fixed income funds. And over the next month and a half, we are accumulating positions that qualify for the 351 exchange. So
Yeah.
this is limited,
I'm seeing, Matthew,
before
a question.
March.
Yeah, there's a question. Well, there's a question on that. What's the open time for the 351 tax-free exchange?
We'll be closing positions on March 1st. So the steps for that is, I have my contact information here, but send an email to me. We can connect on a call first, but I'm fielding portfolios. Excel files work great. We send them to Title, the trust company we're working with on these, and they run a diversification test and an optimization test. Specifically, we'll tell you what qualifies for the 351 exchange and what should be sold potentially in the best proportions to reduce capital gains tax paid, and still qualify for the exchange.
If you're providing a diversified portfolio, like it's SPY, but you're looking to have the downside protection now embedded in that, there's no issues with moving that over. But if it's a more concentrated position, a portfolio that has more than 25% in any one name or more than 50% across the top 5, we might have to do some reallocation within that portfolio. And that's when you send the portfolio to us, we can give you that information back right away, optimize, saying, okay, here's how you minimize taxes, still move it in here with the 100% upside exposure, downside protection. You also have some flexibility in doing this. If everything that's in the portfolio that you're moving over is all large cap growth, for example, there is the ability of saying, you know what, I want to reallocate some of that to small cap, or I want to reallocate some of this to large cap blend. And that's what we're getting the portfolios evaluated for now, to determine which of those portfolios can go to those target funds that are desired by the investor. We have some limitations on that, so it's going to be first come, first serve, but it does give people the flexibility of not only getting the downside protection, but retaining upside exposure to potentially something that's a little different than what they currently earn their money in.
Excellent. And we have a question about the performance metrics shown, whether they related to a specific fund. Those are averages. So I'll just jump to it. So this is an average across Brandywine's 6 U.S. equity funds. Like Mike was hinting at, a lot of asset managers will cherry pick their top funds. It's because they don't have a repeatable process that works. They've been lucky, and over time that luck decreases to a 9% probability of outperforming. Brandywine has a repeatable process that's simple and it's just based on math, and it has these added benefits that transparently we didn't go out, for example, like the dollar cost averaging. We didn't realize how much of a positive impact that would have on the portfolio. We knew that the only rule we could follow is if we can reduce losses, you have a high probability of increasing returns, and baked into that are all these other benefits, right? And because of that, because of the repeatable process of it, we're able to look at averages of Brandywine's funds instead of saying our small cap fund was this, or our large cap fund was this.
There's no cherry picking here. This is just across the range of funds. And that's something you just don't see that with other fund families who are cherry picking a few funds to show you the outperformance. We have another question I can answer here, and it's about the diversifying assets. So the return driver diversifier, that really goes back to Brandywine's 40 years of experience and broad return driver based strategies. And that is a portfolio that's it's lowly allocated to it. It's trying to earn that 2% a year return to pay for the put protection. And it just has about 100 different markets that we're looking at globally that are anything from financial markets, stock index, currency markets, as well as commodities. This past month or two, some of those commodities that we have in there are long exposure to some of the metals. Now, those positions have been dramatically reduced because that portfolio automatically adjusts for the risk inherent in each position. And they trade across about 40 different strategies, fundamentally based strategies, behavioral strategies that are identifying different positions across those 100 markets that we want to be in. At any one point in time, we might only have 40 positions because there's not everything's always an opportunity, but those 40 positions create returns that have zero correlation to the underlying benchmark. So they're purely there to earn the cost to pay for the put protection. They do secondarily, though, provide some additional value to the portfolio through a little bit of non-correlation.
Okay, well, I think that's about our time here.
Yeah, thank
Again,
you.
yeah,
And Matthew,
thank
give them your email again. So that's how people can contact us and send over the information on the portfolios. And we'll just do a quick analysis and get that back to you.
All right. All right, thank you.
No problem. Appreciate
Thanks,
it.
guys. Yep.
And reach out to Matt if you need slides or whatnot and all that stuff. And again, I'm going to announce it that 401ksite.com, further information on the live events. The live events cost money to attend, cost money to sponsor, but you get a nice meal out of it. We do a stadium tour, meet and greet with a Chicago will be a Cubs great. Sometimes they're not so great, but whatever our budget fits. And
I've met some great ones, Ari. I mean, so far I
you
haven't been
know,
disappointed at all. You've
you
had some great
know,
players.
Larry, our buddy Larry, always brings in great guests. Very few times do I. The only time I ever requested somebody was Mark Langston in Anaheim, and he was great.
He was, yeah.
But yeah, we're doing Chicago, Denver, hopefully Washington D.C. in September. And of course, like I said, it's as cheap as $500 to sponsor, $100 to attend, $50 if it's a multiple attendee from the same firm. And again, I got to show my books on Amazon.com. And our next presenter, Mike, you're right there from 41 Go. That's perfect.
I am here.
Perfect timing. Take
Bye,
it away.
guys. Thank you.
Thanks. So, Mike, 41 Go, proud sponsor of all our events. They've always been a big help for me in the last few years. So, Mike, why don't you take it away?
Yeah, I appreciate it. Thanks, Sorry, for handing it off, and thanks everybody for attending. Excited to be here today to give you a little bit about 401 Go and what we do. Let me just bring up our deck real quick so you have something better to look at than me or Ari. Here we go. Everybody see this okay? Just holler if you don't, but I'm going to keep moving forward here. So 401 Go is a newish record keeper, digital record keeper, right? We've seen a few of them launched in the last 10 years or so. The word is really getting out. I'll kind of go into the details about why us and who us in a second. But what I can tell you is we were founded about 6 years ago. It took a little while to get going and get our feet under us. We were at 2,500 plans at the beginning of 2025. And as of right now, we are over 5,000 plans. So we doubled in size just in the last year or so. The word is getting out there, and I'll kind of show you here in the next few slides why and why people are flocking to us and where we play well in the retirement plan space. To go back to our founding story, these three guys on the screen, one of them seems to be cut off here, founded this company together about 6 years ago. The two brothers on the right owned multiple businesses, and as they started to want to get a retirement plan set up for these businesses that all had common ownership, they really struggled to find an affordable solution that didn't involve bringing in an outside TPA costing five, six, seven, $8,000. The gentleman in the middle there, Nate, is a IT guru and coding nerd, for a lack of a better term. These three guys decided, hey, let's put together our own 401k platform for small businesses like ours. So that's what they did. What makes us really different than some of the other providers out there is we own our own tech stack. So we own our own record keeping system. We're not paying a monthly fee to an Omni or an SS&C or somebody like that. So everything we have is proprietary. which also means you're never going to have to go through any kind of platform migration or anything like that. We do currently focus, or not only focus, but our primary focus is on the smaller market. Here you can see this is called our Blue Ocean strategy. The amount of small businesses that we have in the United States, right, just continues to grow. With some of the state mandates, there's a huge opportunity there to service those plans. So what we're seeing, for us, the business that we're winning is primarily in the sub 2 million space. One other thing that makes us different, we're currently fully bundled, meaning you don't need to bring in a TPA. But with the work that we do, we are acting as the 316 on the plan, overseeing all the administration, acting as the fiduciary on that. We do also offer our in-house 338 at no extra cost if you want to use our lineup. But if you want to use your own lineup, you are able to act as an outside 338. And we'll go over some of the pricing in one of the slides coming forward here. Now, I can do a lot of talking, but at any time, if anybody has a question, feel free to chime in on the chat, and I'm happy to answer that and make this a little bit more interactive. As you can see here, before I go through some of these, on every one of our slides, you're seeing 401 Go employees. Unfortunately, I was not handsome or pretty enough to make one of these slides. So this is Jen. She is head of our marketing team and runs a lot of our marketing strategies and campaigns. Again, not stuff that most of the folks on the call are not familiar with, right? Secure 2.0 has obviously changed the landscape. There's the state mandates, there's the mandatory auto enrollment for plans that have over 10 participants. So a lot of the plans that we're doing are having, all these features, the auto enroll. We're seeing a lot of Quokka plans that are being set up. One thing we try to make easy is the advisor experience. We're very advisor centric. Part of our platform tech is making our user interface for advisors all inclusive. So you'll see a couple of screenshots here. Here's one of them. Advisors through our advisor portal are able to access the document center. You can have your outside 338 agreement. All your billing can be done through 401 Go. One of the other things that makes us super advisor friendly is our compensation structure. We allow advisors to charge an asset-based fee, in combo or standalone, a flat fee, dollar fee. We do pull the ACH from the client's account, so the advisor does not need to bill the client directly. We take care of all that for you. We pull from the client's account. It's part of our user agreement, and then we send those to your bank account that's on file. For startup plans, we also do allow advisors to charge, or not just startup plans, but also plans with assets, a one-time setup fee on top of your flat fee or your asset-based fee. What we're seeing is a lot of advisors coming to us. They're not having to use a TPA because 401 Go does all the TPA work. We see advisors able to justify through the plan setup in the portal. They're saying, hey, I'm going to charge $1,000 or $500 or $2,000 for a startup setup fee, which really makes these startup plans and smaller plans worth your time if you're able to get the setup fee and then the ongoing fee. You are also able to tier your compensation through our portal. You can go, 50 bips on 1 to a million, 40 bips up to 2 million, so on and so forth. I'm not going to pull up the demo. I don't want to bore anybody with walking through all that stuff because I could do that for hours. But post call, you'll have my contact info. I can walk you through the advisor portal to show you how all this stuff is done, how you build a lineup, et cetera, et cetera. So here's just a couple additional screenshots. You can see there your advisor profile. You can put your picture and all that stuff for your clients. That is what's going to show up when they log in to see their plan. They're going to see all your contact information right there as the advisor. Again, this is a screenshot of our advisor portal when you're in there, what it's going to look like. This is the landing page for the plan setup screen. One of the things we've done is we've automated setting up a plan. So again, one of the other things making us real different and unique through this automated plan setup, it walks you through step by step, answering all the plan design questions. You can do this with one of our 401 Go reps like myself. You can do this with your client. I can be on the phone with your client. A lot of advisors do this on their own if they know how the plan is going to be set up. It's a simple 10 to 15-minute setup process. At the end, once you hit complete and you've answered all the questions, within moments, it generates the plan documents and can send them out for signature. If you look at that bottom right-hand corner on the image, you see signature. It will send the documents to the plan sponsor to be signed. Once we get them back, every plan we have at 401 Go does get assigned to a customer service rep. I think it's important to make sure that's understood. We're not sending you a 1-800 number. You're not getting a pooled team. Every plan, non-solo K, that comes to 401 Go gets assigned a customer service rep. You're going to have a phone number. You're going to have an email address. All of our staff and service is based in the United States. The majority of our employees are out of Utah, where the company is headquartered. Again, some of the technological features on here. I'm not going to spend a ton of time on this, but you can see we have the app, we have everything, right? We are a tech company, so you would expect that we have all these things for every participant, employer, and advisor at your fingertips. Again, some of the key features, I don't want to be too repetitive here, but what really makes us different, onboarding plan, we set up plans in minutes. Because of the technological capabilities, we're able to, I will tell you, on December 15th, we were still setting up plans for 1/1, accepting paperwork and able to get things going that quickly, right? Versus some of our traditional insurance record keepers, even some of the other digital record keepers, they need 30 days, 60 days, 90 days lead time to get a plan going. Our cutoff is typically 2 weeks before the end of the month. Again, the invoicing, we do bill the clients, we direct debit and take those dollars out. So you're not having to send your plan sponsors a bill to say, hey, you owe me $1,000 or $2,000. And you can set up the fees as often as you like. We can do quarterly, you can do monthly. When you do the advisor pricing setup, it's going to give you all those choices. How we help your clients overcome challenges. We understand, right, as advisors, your days are busy. You're servicing many clients. A lot of you guys also and gals also do wealth management. So for a record keeper to be a good partner, we want to make things as easy as possible for the advisor. Again, that is why we assign a customer service rep to each plan. You have your regional wholesaler. I cover the Northeast. We have 5 other people covering the rest of the country, here to help you with everything. We feel in the industry, and you'll see through the awards that we've gotten, we have the best tech. We have all the people in-house that understand the landscape. We do plan design. We do cross-tested profit sharing. We do cash balance plans. We provide you everything that you need. The tax credits really help offset right through Secure 2.0 a lot of the setup by doing the auto contribution. Employers able to get that extra $500 credit. And then on the right again, fully bundled provider, acting as a 316, acting as the 338 if you want it. A lot of the traditional record keepers, you're going to go to Voya, you're going to go to Trans, you're going to go to Empower. Great products. I have a lot of friends that work there. I'm never going to talk bad about anybody else, but they are going to ask you under $1 million to go TPA, which is going to add $2,000 or $3,000 cost to what you're doing on top of whatever else they're charging. Video for the advisor portal. It's about 2 minutes long. I'm not going to run through it right now. It's just going to repeat a lot of the stuff that I talked about. But if you want a demo, I can either send you login credentials. If you email me after this, or you can call me after this, I'm happy to send you the demo credentials or set up a 15 or 20-minute call to walk you through to show you how 401 Go does everything. Again, digital record keeper, we own our tech stack. What does that mean for us? Our pricing is very competitive with what you're going to find in the marketplace, especially for a bundled provider. Go Plus is our standard 401k 403b offering. It starts at $125 a month. You can see the rest of the fees right there. 15 bips AUM fee. Part of that does go to our custodian. We are custodied at Matrix. Custodied at Matrix, what does that mean for you? Everything that Matrix offers in their mutual fund and ETF universe is available for you to use. We also have CITs that you can use if you want, right? That's a separate CIT agreement. I won't go into the details there, but R6 shares, index funds. We have no proprietary funds of our own. We don't have co-branded target date funds. We don't have a stable value fund. It's up to you to pick whatever you want. Again, if you want to go with our in-house lineup, it's got Vanguard, it's got American funds, it's got DFA funds, all on there. The average cost on our 338 portfolio comes out to about 27 basis points. Starting point $7 per participant, and that is on a sliding scale. As the head count goes up, that dollar cost does go down. And we have a one-time $500 setup fee. What I will tell you is that is the starting point. Once you have 5 plans with us, you are considered a preferred advisor to 401 Go. Your per month fee automatically drops to $110 for every plan that you do with us going forward. And what I tell advisors, as they start, after they've had 2 or 3 or 4 plans with us, that's when we start seeing some of their bigger plans moving over, right? Your $2 and your $3 million plans. I will tell you, most of the plans we do are 5 and below. We do get the occasional 10, 15, $20 million plan, but I wouldn't tell you that we're in the place to handle, right, a $50 million 2,000 participant plan right now. That's not our space, right? I'm sure we'll move up market as we continue to grow and scale our operations. But the smaller micro space is really where we're concentrating right now. So your pricing does drop to $110 a month, but when you do have a $2 or $3 million plan, we custom price every one of those. If you have a plan with 60 participants or 70 participants, right, we're obviously not going to charge $7 per head per month, right? That's not an annual fee, it's a per month fee. So off the rip, if you say, Mike, I want to bring you an 8-person plan, what is it going to cost? All in, it's going to be about $2,000. I also want to caveat, once you hit that 5th plan, you no longer have to pay that $500 setup fee. Won't go over the other pricings, but you see we offer solo case, very affordable. And then we also have a PEP that we can offer for those advisors that are interested. Our awards and our recognition. I won't go into all the details here, but you can see this is, I think, the 3rd or 4th year in a row we've been a top record keeper for Napa in the small space. You can see all the things we have accolades for, their advisor support, staff credentials, et cetera, et cetera. G2 is a service that rates digital record keepers. We scored 4.8 out of 5 stars on there, higher than all the other digital record keepers, your Vestwells, your Betterments, your human interest. We year after year have scored the highest marks through G2. And then you can see there we have, obviously, we continue to get recognized, as a top fintech firm for what we're doing and how we're doing things differently in the industry. And again, there's Dustin. He's my counterpart. He does handle the southern states, Texas, Midwest, for 401 Go. Some testimonials. I'm not going to read through them right here, but obviously the advisors that use us love us. We don't get a lot of onesies, twosies. Typically, most of our advisors have 4 or 5 plans and above. Once they try us out, they see how we're servicing these smaller clients that have been neglected, for years with the bigger providers. That's the reality of how it plays, right? Your Empowers, your Voyas, they'll take the micro plans, but they're not going to service them that they're servicing the way they're servicing the 10 and $15 million plans. We're giving every plan the attention they deserve, and we have a commitment to continue that service model going forward, right? It's only a differentiator when you continue to service things that way going forward. They put me on the last slide here. That's where I guess I belong, but there is my contact info. Obviously, I didn't take up the whole time here. There's plenty of time left for questions. My direct line, if you want to, chat with me, please give me a call anytime. If you're not in the Northeast, I can obviously connect you to the right sales rep. My email address there. If you'd like a demo, you want to send me the demo credentials. If you say, hey, Mike, just give me some of the marketing materials. One thing I forgot to mention, when you get access to our advisor portal, you are able to run your own proposals. It literally takes 2 minutes. Click a couple buttons, answer a couple questions, and the PDF is ready to go. You don't have to do it that way. You have your wholesalers. We're happy to run the quotes for you. But if you need something in a real quick turnaround time, you do have the access to do that. So I'll pause right here. Ari, is there any questions from anybody or anything in the chat?
Yeah, there was a question, Mike. How do you use AI in your business at 411 Go? That's an interesting question.
How to use what?
AI.
Oh, AI. Well, I personally am not, a master of AI at 51 years old, but where we're seeing it right now is in the day-to-day, conversations we're having. Our marketing team, I'm sure, is doing a lot with AI, but we use a ton of Ask Elephant, which is a digital note taker. They watch over and listen to all of our calls, right? So I can pay attention to my advisor and our plan sponsors when we're having conversations. Then we can read the debrief afterward and see if there was something that we missed. And then ironically, they do Ask Elephant, which is the one we use, does actually score your calls after and tell you what you did well and what you can improve on. So I guess that, you know, age 51 here, we're still learning how to talk to advisors.
But what do being more tech savvy, what are the advantages that you see over, I hate to say it, but there are TPAs that are, still, I think, stuck in the 1980s. I mean,
Yeah, no,
I don't deal with them, but there are some that are just stuck in the 80s and 90s.
Yeah, no. So I'll tell you the big difference is we listen to our advisors and we want to provide you with what you want. So again, we own our own tech stack. We have, I think it's 7 or 8 coders that work on staff. So if you say, "Hey, Mike, we really would like to add this feature to the advisor portal," and we have 5 or 6 or 7 advisors that have asked for that, we can make that happen, right, within a month. That can show up. Whereas your other, traditional insurance providers, they have to go to Omni, let's say, and say, hey, we have a request. They have to put a work order. It can take, right, 6 months to a year for them to roll out technological enhancements. We're rolling out new stuff every month as we get feedback from our advisors and our plan sponsors and our participants, as to what they need and want. So, in addition to that, again, it just goes to our plan setup. We're setting up plans, 15, sometimes on an exception, 10 days before the end of the month. As long as those signatures come in, we can on 12/15, right? We were getting plans, they were having implementation calls before Christmas. A lot of our other providers, they need a 30, 60, 90-day lead time to get a plan set up and running.
Yeah, I mean, I think that is probably a differentiator because with some record keepers, it just takes forever
Yep.
to get on. That's always the most traumatic experience. That's why I always try to avoid changing TPAs.
Yeah, and I don't want to bash TPAs, and they do a great job. I have a ton of
No, they
friends
do a
in the
great
T.
job, but I mean, yeah, uh,
It's just, when people are, sometimes cost conscious or sometimes you can have too many cooks in the kitchen, right? We have folks that have worked at TPAs, on staff and we act as our own TPA. We've had requests to partner with TPAs on plans, and then it just comes down to just, a cost question. We're pretty economically feasible, as you can see from what we charge. For me to come down on my cost by $300 or $400 and then the TPA to come in and charge 2,500 on top, right? Who's going to go with that option? When we can do the whole thing for $2,000 to $2,500.
absolutely. Mike, I appreciate it. And again, before I get to the next presentation, the beauty of this is, again, the event's free. If you gotta go, you got lunch, you got a client meeting, we will have this on YouTube, maybe as early as tonight. We do this again tomorrow at 11 a.m. to 3 p.m. Noon tomorrow, we'll have that 401k bunch, which is this kind of fun group that we've had the last couple of years. It's me, Mike Webb, Bill Shores, and James Holland. We'll discuss some of the events that are going on in the 401k space, and I'll try not to dominate the conversation as the person handling the topics. I always feel like Bill Maher on his show. I don't know why he hosts it. He just should just talk to him, say what he has to say because he doesn't let the guests get in edgewise. But as far as that, again, I'm going to still shill for my events at that401kside.com. 401 Go will be part of the events in Chicago and Denver Um, and of course, the books are available on Amazon.com. I'm going to check later to see if I sold any books today. Available on Kindle and paperback. That 401k Plan Provider Handbook is the book that I'm shilling for now. And our next presenter, we're of course starting. People finish up early. I run a lean ship around here. It used to be bad when I used to these events. The precursor to these events, I used to go to these events around the country. Well, I went locally, and we would talk and talk, and certain speakers would go over the time limit, and it would be ending up like an hour, later or whatnot. So I try to run a lean ship. Sometimes we arrive early and finish early and whatnot. So I wanted to introduce Courtney from Pacific Life. She's been a big help for the events for the past year and change. Hope to see her in Chicago in April, and I'm not looking forward to Chicago weather in April. But then again, I got still about like a foot of snow that's frozen in my house outside. Expecting another 3 inches on Sunday, so I'm not looking forward to that. So Courtney, take it away.
Excellent. Well, I'm in Colorado and we still stay in the 60s, so you guys have kept all the snow. So thank you for taking one for the team on all the snow. Thank you, Ari. I know I love doing these and getting the word out. I feel like the retirement income conversation is one that can be a little, I would say, eye rolling, and or we're like, ugh, another income conversation. But today, hopefully, I would like to help us just delve down into what does the income process look like, and not necessarily does an income solution fit every plan, which may sound odd coming from a annuity provider. I started in this industry actually as a compliance officer, so at an annuity firm. So I feel like if there's anyone that'll tell you when an annuity is not appropriate, it's probably me. It gives me the heebie-jeebies when we do these things incorrectly. And I do think we've got a lot of opportunity in the space, and it's a topic that's not going to go away. So the more that we can educate and find ways to help each other through delving out what is seemingly a complicated topic, it's really just more complex, which we could argue a lot of just plan design in general is complex. So I'm going to try to share my screen here, just to give some visuals that's not just my face. And we will go from here. Aria can probably just tell me, make sure you can see my screen on there.
Yeah.
So like I said, I want to start off by saying I don't believe every plan needs an income solution as far as a product, but every plan does need a decumulation process. I think we've all can agree that 401k plans have done a tremendous job, or we do seek to do a tremendous job of creating savings vehicles. But we get to the end of a participant's career, and then it's this big lump sum of money, and some know what to do and some don't. And behaviorally, participants are starting to look at their accounts around age 52 for what they can take, not what they can save. And so these income solutions really have been developed to try to help, again, create that bridge over to the wealth side. So that's the first thing to think about, is how does this help really bridge the gap to the wealth on the advisor side? But also, how do we help that population that maybe just doesn't have the advice that they need? I like to say that there are three types of advisors that we work with. We work with our plan advisors, we work with a plan and wealth advisor, and then we work with the participant as the advisor, which in a lot of situations can be detrimental to a lot of different situations. But we do have this third bucket of participants. I would argue there's not actually enough advisors in the country to cover as many participants as actually need help. And a lot of broker dealers have made it difficult to take on clients that don't have 500K in investable assets. So when we think through these solutions, let's think through those participants. Not necessarily just because you have a lot of money doesn't mean you don't need one, but we really are trying to solve for that market where the advice and behaviorally have the thought process is not there for distribution. So I want to start by talking a little bit about participant risks. So when we talk about our participant risks on the left side, we see that there's participation risk, contribution risk, and investment risk. And we solved for these. We have auto enrollment, we have auto escalation, and we have QDIA. So as an industry, we've been able to really solve for what this savings plan needs to help participants get involved. We also know that it's like banging your head against a wall to get in front of our participants once you started them on these things. But so many are grateful for these particular items inside their plan because they would have never known what to do otherwise. The side of the equation that I work on is these other three risks, which are market risk, conversion risk, and longevity risk, which in a perfect world is where typically you'd have this 401k, it grew a bunch, and you roll everything over to your advisor. But like I said, we've got a lot of different scenarios now and a lot of different participant situations where market risk, conversion risk, and longevity risk are harder to solve for, especially when we aren't working with a high net worth client and it's harder for advisors to convert that into the wealth side. So, Pacific Life, as we know, is not a name that we typically see in the 401k space. But we're all, I'm sure, on this call very familiar with some of the firms that have income provisions, and by no fault of their own, maybe kind of soured the pot a little bit for us as the income space has grown. Technically, income solutions have been available for many, many years. I have particular contracts that go back into the late 90s or early 90s, excuse me. So these income solutions are not a new development. They're just gaining more awareness. And again, we have maybe a sour taste from some of these products that didn't allow for portability. I would say the one word I hear all the time is portability. And hopefully after this presentation, you will have a little more solidarity that as an industry, we are getting closer and closer to having that portability that I think is the concern. I never like to necessarily throw a competitor under the ground because rising tides raise all ships. But TIA was the first one that came out with a great annuity inside of their plan, but it is an act of Jesus for a participant and or an advisor to help move the plan or the participant out. So that we know, and again, as an industry and as solutions providers, something we've definitely really tried to accommodate and be very cognizant of as we continue forward. I want to talk a little bit about what are some of the ways that we can generate income in retirement. So the first thing that we think about is how do I start talking to a plan about income and not make eyes spin or this complex, complicated thing that nobody wants to talk about. Let's start by asking the plan, do you want to keep the assets in the plan or would you like the plan assets to leave? As soon as we do that, it actually takes about half of the solutions off the table, and I'll show you that a little further along. But what it also does is gives us this thought process of are we keeping money or are we taking money out? And that's where generating different income solutions in retirement, this slide is super helpful. So as we know, systematic withdrawals. If your plan does not allow for a systematic withdrawal, I would deduce that they do not want participants to leave their plan. They want to keep those assets. They want to keep that AUM. Now, if it's just an oversight and they haven't added systematic withdrawals, make sure your plan allows for systematic withdrawals. I've seen countless numbers of plan documents that require a participant to pay an extra $25, $30, $50 just to get their money out. And so if we are trying to keep money in the plan and we're going to let it drip out slowly, systematic withdrawals. For a lot of participants, their 401k plan is one of the most inexpensive ways for them to keep their money invested. The next piece we have is managed accounts. We know managed accounts are making another run. It's almost like income, but maybe a couple years before. But managed accounts, and on the managed account side, you will see that on personal wealth. So most clients will have some sort of a managed account model, customize something for them that an advisor has built that they're taking money out of, and they're pulling from the income portion off the fixed income, which, fun fact, most participants actually think that they have an income solution because there is a mutual fund in their lineup that says fixed income. So just something to kind of keep in mind. Most participants actually think they have income already built in. But I digress. Managed accounts, again, usually advisor driven. Managed payout funds. There are a couple of carriers out there and asset managers who have managed payout funds. There are a few that actually have paired those with an annuity. We have a solution with T. Rowe Price that does just that. But essentially, they are managing the payout for the participant through the asset manager. Does alleviate some on the advisor piece of it, but takes that managed payout fund. The next three are where everybody's ears start to twinge. I feel like we kind of get this little and it's because we start using the word annuities. Annuities in our industry sometimes have a very negative connotation, but I would say in this space, most of the annuities that are out there in the plan space are the simplest, cleanest, and most inexpensive way to do it, which is usually the biggest hurdles that we have out in the retail market. And it's also something that's being sold versus opted into or being helped. We have some discretionary capabilities here inside 401k plans, which is very helpful. But we have in-plan accumulation annuities, immediate income annuities, and QLACs. For those of you that aren't familiar with QLACs, these are gaining a lot of traction, especially to help satisfy RMDs. There are some regulatory restrictions on QLACs in that you can't have more than 210,000. But to put into perspective, if you were 65, you put it $210,000 into a QLAC, say with Pacific Life, and you take your money back in 15 years, so it's just a give me your money and wait 15 years, it would come back to you at about $68,000 a year for the rest of your life. So starting at age 80, think of it as a nice long-term care kicker, or maybe we've run through some other buckets of money and now we've got another income solution that's kicking in. So something to think about on QLACs. That 210 is a little less daunting than some of the numbers we can put into some of these annuities. Immediate income, that's going to be a SPIA, so a single premium immediate annuity. These can be done on any plan, regardless of record keeper, with multiple carriers. I will tell you this is a shoppable market, so most people are going to be using multiple carriers to shop the rates. But you typically are in an institutional rate, and the institutional rate is quite a bit higher than retail. The last time I looked, at 65, I was paying out 7.9, I think is where we're at right now, and my retail counterpart is at 6.6. So there is a noticeable difference when the plan is offering it, and it does change some of the nuances. There's also compensation involved if you're an advisor that takes compensation that way. So again, things to think about, but a solution for retirees that are at retirement. And then this in-plan accumulation, you'll notice that I've come back to that kind of at the end, mostly because, again, this is, I think, where when we think of income for 401ks, it's the only thing we think is available is these in-plan accumulation annuities. Again, I'll be the first to tell you that it is not appropriate for all plans. If you've got a very young demographic, let's say your entire demographic is under the age of 30, an in-plan accumulation annuity is not something you're even considering for that plan. So it is fairly simple to delegate and get some of those plans off the list of necessity for an income solution, but more so looking at the demographic. So those are the different approaches to the income that we can look at. So then what are our participants feeling? So if anyone has changed jobs in any point in their career, you typically get an email that's like, here's your options for your 401k. Now, there's a fifth option on here, which not everybody has, but really we believe every plan should have. But you can leave the money, roll it to an IRA, start a new 401k at your other employer, or cash it out. Those are the options until we also have this and choose an immediate annuity. And like I said, we believe that every single plan should have an immediate annuity on there. It is an at-retirement solution to be chosen. It helps with that pensionizing or however you'd like to think of it, D being your DC plan, but does give an option for lifetime income to cover some of those expenses and at least start a floor for our participants. This next slide will make your eyes swim a little, but it's one of my favorites. It's one of our partners, Nestimate. Those of you that have not heard from Nestimate and are interested in looking at a retirement income planning tool that helps you look at what the plan needs from an income solution, Nestimate is phenomenal. And you can always ping me after. I can help get you some samples of what their reports look like if you have some plans that you'd like to assess. But the nice thing here is you can see all the different carriers. There's a lot of repetition, so it's not quite as busy as our eyes would think, but when we think about what I said at the beginning, does our plan want to take income out or make it stay in the plan? That takes this entire graph and makes it easier to digest. So to make all of this just a little simpler, I want to start off by, or want to go into a couple of plan examples. We talk a lot about why income is important for the participants, and I think everyone would agree. We all agree income is important. We don't want any participants going into retirement feeling like they're going to run out of money. I mean, there are scenarios where it's going to happen, but if we can set them up for as much success as we can from get-go day one out of the plan, that's what we hope to do. But we don't talk as much about how do we look at these income solutions from a plan design level. And so I want to start with plan example 1. There's a lot of extra information on here that doesn't make anyone need any of that, but it's just nice to know. So the demographics. So they want to retire a little early. They're going to retire maybe 55 to 60. They do like tech. They're pretty savvy. Retirement planning is important, but they have high turnover, something to think about. The next one from there, you have your plan design elements, and this is really where you're going to focus. So if the managed account is your QDIA and you have auto enrollment already, student loan tools, and some debt emergency saving tools, we've covered 3 of the biggest pieces, which is helping people get in and start saving. I would argue student loan tools are one big part of that. But the big line item for when thinking about the income is your managed accounts as your QDIA. So when you go to the next box, the orange one below, we look at what's a possible income solution. Well, a managed account with income. Now, if we go back up to this beautiful slide, like I said, from Nestimate, we can start going directly to managed account and personalized solutions. And we've now just taken us to just one box to look at instead of this entire universe of income solutions. So it's much easier when we know what the plan needs and what the plan is going to have as an investment solution to help us decide if an annuity solution is a good thought process. And I always put, again, the at retirement, SPIA, and QLAC. I will keep hammering that in. The world that we live in, and as we know, where income has evolved and where it comes from, there is going to be a market for the people retiring in this year, next year, 3-year mark, that don't have time to save in these accumulation annuities. And so giving them that capability of having a slightly higher payout out of the plan is just something to continue to consider. We'll look at one other plan example. Again, a lot of extra information, but these are all things that you have to take into consideration when you look at a plan. Again, when I'm looking at a plan and we're looking for the income solutions, what's the first thing? Our target dates are QDIA. Again, we have auto enroll, we have auto escalate on there, and they do like financial planning and advice. So this may be a time where the advisor is going to have more involvement, even with the accumulation solution and or with that at retirement solution. But again, we go down to these possible income solutions and we say target date with income, and that helps us delve it down as what the QDIA is. So if you look at, again, here we have a few less boxes, but really this middle section tranche, and again, not as many logos that you have to RFP through to look at. Like I said, this Nestimate slide is one of my favorites, but they do a phenomenal job in helping digest and look at each different carrier. So again, if it's something you have of interest, please let me know. I'm happy to run you an estimate scoring report for any plans you have out there. As I already mentioned, I know we always tend to run early, so I'm still on my 20-minute mark, but I know we're still running pretty early, but I'm going to start to finish up here with just a few of the last thought processes that we can have. And really what I want to leave you with is that income solutions do not need to be a daunting task. It shouldn't be the last thing on the list that you're thinking of talking about, because we can really start to delve down what a plan needs. You don't want to lose a plan or be moved to a different advisor because someone positioned income. As we know, everyone's always looking for the next big in. Income is one of those ins that I'm seeing more and more. I told you I used to be a compliance officer. Sometimes I think it's inappropriately used. We're telling a plan that is not appropriate for an income provision that they should switch advisors because they never talk to them about income. But again, there's ways to talk about what is our process, and even for those younger generation demographics, there are ways to have that income conversation, knowing that you probably don't have the need for it, but at least again having the conversation during those plan reviews. So if I can leave you with anything, it's this slide. This is what I think it's my easiest way to start the conversation is what are your plan goals? What are your plan demographics? Who's your record keeper? And what's your current QDIA? And that's what gives us that income solution, and or gives us a couple of providers to look at and makes it simpler. Pacific Life, you will see our logo in a couple of different areas. 90% of what we do are for plans that have assets leaving the account, so it's going to be an annuitized product. We believe that that's the simplest and highest dollar amount that we can give to a participant, so that's where you'll see us. But you will see us also in some of the in-plan longevity type annuities as well. But our focus is how can we make this as simple and easy and portable for you as the advisor. You'll see that Record Keeper is on here, and I know I made mention, but 20 years of income, and there's still only a few providers that are actually getting any flows into these income provisions. Again, something to consider is that we are worried about moving it from Record Keeper to Record Keeper. We think about as an industry where we've come with AI, where our technology in general has come, our capabilities, and to plug your blow dryer into Europe, you can actually start doing that now with some of the capabilities with our middleware providers. So this record keeper transition and who is sitting where and what is actually going to be your smallest hurdle. The biggest hurdle will be that you didn't have the conversation. So I would love to be a resource. Pacific Life, like I said, is committed to this space. We are not a record keeper. I'm not an asset manager, so we plug and play into a lot of different areas and hope to give you as advisors and plan sponsors the ability to pick the right income solution for your plan, but also have the flexibility to make changes and move that as necessary. So that is where we sit. And again, I apologize for going a little bit early, Ari, but I can pass it off to the next speaker.
We do have a question.
Oh, sure. Oh, I didn't even think to ask for questions. I would love to answer a question.
It's not a problem. One of the issues I've experienced with retirement income solutions is cost transparency. Do you feel that this is an issue, and how does Pacific Life address it?
Excellent question. I believe it has been an issue. I think that fee transparency in general as an industry is definitely something that I think we're all looking to overcome. I think fee transparency, it's hard to hide things in these systems. The nice thing about the annuities that, again, Pacific Life specifically, I'll talk to mine and then I'll briefly mention some others, but that we work on, again, annuitized products do not have necessarily an upfront fee. You don't start a SPIA by paying someone. So everything that annuitizes, we negate some of those extra expenses and fees. So that's why when we talk about adding an at-retirement SPIA, there's no expense or anything additional that the plan sponsor or the participant has to pay to do that. It is a spread product. Now, the transparency on some of I'm going to start using some acronyms, so I apologize if we get lost in some of the alphabet soup, but a GMLB, GMWB, when you have step-ups and you have watermarks and you have different asset classes that things are capturing off of, that is where the fee transparency does get murky. But again, as an industry, and I think as a challenge to each other as providers, it is becoming much less of an issue than it used to be. So I'm not going to say it's not still out there. We don't still have some products that have a little bit of, again, murky water. But for the most part, these products are being built to be just as transparent as the plan itself needs to be as you're designing going forward.
Okay.
Hopefully that answered that question.
No, I think it certainly did. And looking forward to seeing you in Chicago.
Yep.
Like I said, I shouldn't really be dreading the weather when I still have all that snow outside frozen. But we'll see what happens.
I'm sure it'll be nice. I'm sure it'll be nice.
Yeah, and that's I think the Mets are playing that Friday, so I'll have to go to the game. That's on Thursday in April, I think April 13th or whatnot. It's the logo's in back of me, and I think it's like for some reason
the 16th.
Oh, the 16th. See, I don't even, like I should get the right day for whatever. I know it's sometime in April, and it's on a Thursday. Usually we do it Fridays, but this year we're doing it this one on a Thursday, and I think Colorado is on a Tuesday for some reason. Again, I think it's all because the Mets are in town that somehow my son worked it out this year. And And again, go to that 401ksite.com, $100 to attend, $50 per head, multiple attendees, same firm. And for the plan providers who want to sponsor, sponsorships start as little as $500, $1,500 to speak for a half hour, $750 if you want to do a stadium tour and all that kind of stuff. So hit me up if you're interested. It's really fun. And like I said, also buy the books on Amazon.com. And Wes, are you ready? Our next presenter is going to be Penchex Trust. Now, I grew up in the old days when we had terminated plans. Uh, when we had terminated plans and we had missing participants, we did something really rude, and that was we sent all the money to the government. We did 100% withholding rather than doing the right thing and you know, force out rollover IRAs wasn't really a thing. So, Wes, tell everybody about the great work that Penchex is doing and why you shouldn't wait till the very, very end when you're terminating a plan to do the IRAs.
Yeah, thank you very much, Ari. Thank you for having me as a speaker today, but also just allowing Pinchecks to have a floor. And certainly thanks to all the attendees today for taking time out of their day and listening to all the speakers and certainly the great conference that Ari just continues to put on time and time again. So I'm gonna share a screen real quick and we can kind of jump into it. Making sure everyone can see my screen, right? Because I lost sight of Zoom. Can you just confirm for me, Ari, that you're seeing my screen? Was that a yes? Sorry. There we go. Can you see it now? I'm gonna proceed forward as if everyone can see my screen here, and hopefully I can actually turn the presentation screen on and it actually works. There we go. So first and foremost, again, my name is Wes Skeevers. I serve as the Vice President of Advisor Solutions for Pinchex. So my main role is to drive our advisor channel. As Ari kind of mentioned, Pinchex has been around for a long time. We just celebrated our 30th anniversary. And we're most well known in the industry for processing distributions, being an automatic force out provider, the associated tax forms, and we're absolute experts at managing plan terminations. My focus today is, and certainly I'm welcome to take questions on our force out and plan termination services. My main focus today is going to be actually on the title, which was from leakage to growth, and basically how Next Level IRA can help advisors retain assets and unlock future clients. So a little bit on Pinchex. Again, I just kind of touched on it. 30-year history. We're the largest producer of processing distributions in the industry. We're super well known for kind of doing the back office work that we kind of make fun of ourselves about, which is a lot of times some of the work that Pinchex specializes in is what TPAs and record keepers and advisors don't want to do. So they hire Pinchex to kind of be their back office. Again, 30-year track record on it, and we're quite exceptional on the efficiencies and the scales that we provide when it comes to our core services. Again, with force outs and plan terminations. I joined Pinchex about 2 years ago, and traditionally Pinchex has always kind of their main partners have been TPAs or record keepers, and they brought me on board to help drive our advisor channel, but most specifically to represent a very specific product that we launched and we started building roughly about 5 years ago is when the concept came to fruition and we started actually building the technology. Pinchex has had exponential growth over the last 10 years. And part of that has been a heavy investment into our own technology. I think we have like 50 in-house developers now. And the bulk of all of our tech that we utilize for everything we offer for our services, we own the vast majority of it. Only certain pieces do we outsource. And so when they started developing Next Level IRA, very candidly, it was initially a platform for Pinchex. And what it was going to be Since we're such a large producer of distributions in the market, and we manage, I mean, hundreds of thousands of forced out IRAs on an annual basis, plus more planned terminations than I can count. What would happen is, obviously we were very good at processing the distribution for those individuals who actually took action, stepped forward, and claimed their assets. And whether we gave them instructions on how to claim their assets elsewhere, or we processed the distribution ourselves, for the individuals that were non-responsive would always be moved into our auto force out IRA platform or missing participant IRA platform. In addition, whether it was at the front end when they were claiming their benefit on the front end for, again, a planned termination scenario, or let's say in a force out scenario, they came back a year later and Pinchex again had their assets in that auto force out IRA, they would come back and ultimately claim their assets. And in a lot of cases, what was occurring is individuals would ask, "Hey, can I just, I don't work with an advisor. My 401k plan isn't eligible for me to roll these assets into it. Can I just leave my money with Pinchex?" And we didn't really have a prudent vehicle for them to leave it with us. Ultimately, in a force out scenario, our first prudent responsibility is cash preservation. So there's no QDIA equivalent in force out IRAs. Our job is to preserve their cash and the monetary value of those assets until they make an election. So what happens when they go into a force out IRA, they get dropped into a stable value or a money market. And so again, not to belabor the point here, but like when individuals will come back to us going, "Hey, can we leave our assets with Pinchex?" It wasn't prudent of us to leave it with Pinchex and open an IRA or continue to allow them to keep their IRA assets in a stable value or money market. So we would send them elsewhere. And when we started developing Next Level IRA, it was going to be a platform for us. So individuals that could leave their assets with Pinchex long term and would be a good suitable solution for long-term investing. So it would be a full UX platform, a portal that they can manage their IRA. It came with a universe of good mutual funds that they could choose from that, again, were going to be managed by an investment fiduciary. A discretionary investment advisor, also another word for it, but also came with some level of automated advice. So like a managed account or a personalized model portfolio technology was really important to the strategy because, again, in most cases, these individuals weren't working with advisors at that time or are individuals who are typically not engaged, right? So this kind of set and forget it kind of thought process. When we started building out Next Level IRA, we feel we identified a really big blue ocean opportunity, which is to develop an advisor-centric voluntary IRA platform that was specifically developed and designed for advisors. So we pivoted our strategy, and I always like to point this piece out because this market sometimes has lots of competitors in it when it comes to advisors directly. But you won't see Next Level IRA ever getting marketed directly to an individual investor or directly to clients. Our entire distribution model now for Next Level IRA is through advisors. And ultimately, what we're trying to do and what we designed is, again, an advisor-centric voluntary IRA platform that's designed for advisors to help them retain their retirement plan leakage and then build long-term prospecting pipelines for what would be their traditional wealth management business. Now, the conversation with Next Level IRA is always best suited and kind of a one-on-one basis because all RIAs are slightly different in terms of their objectives, the structure of their firm, what they're serving. Do they have more retirement versus wealth or vice versa, or do they not have any wealth management at all? So the best way I can describe who this platform is built for is literally any advisor that touches a retirement plan, whether you have 1 or 500. There's a way for you to leverage Next Level IRA. We have kind of multiple advisors, multiple advisor engagements on the platform that each will give you a retention strategy for, again, this plan leakage. For the context of today, I'm going to focus kind of more on the advisor that has retirement plans and either has wealth themselves or their firm offers wealth. But again, if you're a plan specialist with no wealth, there's a different way we could partner together that, again, would give you a leakage strategy as well. With that being said, just to kind of, again, lay out an opportunity set here in terms of like, what does the IRA rollover market actually look like? And this screen does a really good job of that, of just aggregating these assets together and actually show right now what a lot of advisors are just letting walk out the door. And so these numbers you're looking at here are from 2023. We're working currently to get this data updated to more recent calendar year. But in 23, 845 billion. I think that number is close to $1 trillion now. But 5.19 million accounts. But again, as you start to break down the data of these IRAs, there's a huge opportunity here for advisors to stop letting this leakage walk out the door and go somewhere else. And it's based on, again, a lot of historical assumptions. So a really good example of that is, 20 years ago, people stayed in jobs much longer, but 30 somethings and younger typically stay in jobs every 2 to 3 years. So if an advisor that's, again, on a retirement plan, but uses their retirement plans potentially to mine and prospect for wealth management prospects, and let's say their wealth minimum of their firm is 100 grand. Well, if you look at an individual that's late 20s, early 30s, that has 50 grand, well, they're never going to hit that number, right? But when you look again back at the length of how long they stay in jobs, it's a pretty safe assumption that they're probably going to have 2 to 3 401k plans beyond the one they've just terminated from or separated service. So when you start to aggregate these assets together, they become really substantial. In addition to that, just where is the assets going today? So this pie chart here is a really good description or a really good illustration of ultimately what's happening with the assets. And the one I want to point out is on the left side, the orange part of the diagram, which ultimately is when the advisor is acting as the intermediary or the supporting kind of mechanism behind the rollover process. And it's 54% of the time when the advisor is the one that is helping the rollover happen. So that could be the plan advisor or just an advisor that currently has no attachment to that retirement plan. Just, again, a professional financial advisor is reaching out to the individual and that's separated from service. They have a balance over 7,000, so they can't be forced out. Again, these are voluntary acts, and they're providing guidance on what they could do with their money. When an advisor is serving that capacity and that consultative role, 54% of the time, the advisor will retain that business and bring them on as a client. When it's the plan advisor that's doing it, again, they already have some level of relationship with this individual because, again, they were once an active participant in the plan. That number goes from 54% to 63%. So it's definitely a very good indicator that if you as the plan advisor are the one that's reaching out to the individuals, consultating them on what their options are, that the likelihood of you retaining them as a client is really, really strong. So moving back into Next Level IRA. Again, I already kind of gave an overview of what it is. It's a platform, a voluntary IRA platform built for you. It's a platform built to help you retain assets and retain clients. Now, it's probably fair to say that, again, when you have an advisor that is serving in a retirement plan advisory role and also a wealth management role, it's very common to have some level of minimums. I come across advisors every once in a while that will serve every account balance size. But in most cases, what happens is once an advisor becomes more established, they start to have minimums. Those minimums I've seen vary from 100 grand to I've seen as high as 5 million. But ultimately, what will happen is you'll have a segment of your business of terminated participants or individuals who have separated from service that have a balance of at least 7,000. So again, they can't be forced out. But individuals that fall under that wealth minimum. For today's context, again, I'm going to use $100,000. So these individuals have terminated, they're residing in the plan, they have a balance above that 7,000, so they can't get forced out, but you're not actively prospecting them because they're underneath your $100,000 minimum of wealth. And they haven't come to you proactively asking you to manage their money. So what happens in most cases is the advisor just allows them to sit in the plan for as long as possible until the individual finally steps forward and claims their assets and they move it somewhere else. And we feel that the advisor loses in 2 ways right away. One is the assets and the associated revenue, right? That leaves the plan no longer getting paid on it, and you lose the revenue associated with that individual. Well, secondly, and we think the bigger play here, the bigger opportunity is once they leave, you lose them as a wealth opportunity forever. You're never getting them back. So what we want to do is build a strategy that helps you very specifically target a segment of business that in most cases you as the advisor are ignoring. And again, to be fair to you, the reason why these smaller balance rollovers have not been historically kind of targeted or mined is simply because there's lots of administrative work, there's lots of compliance and liability associated with them, and most advisors weren't capturing enough revenue to really kind of justify why I would go and target them and bring them on as a client. Well, what we want to do is solve that, right? So not only is it a retention strategy, but we wanted to make sure we wanted to streamline as much of the let's say, communication and enrollment process as we could, automate as much of it as we could so we could reduce that administrative burden. We will actually partner and integrate with whatever compliance or rollover documentation tool that you use today, whether that's an internal document or we've actually built direct integration with Broadridge's Decision Optimizer that's actually built into our process. Or if you use another tool, it doesn't really matter to us. We can partner with you no matter what, but we can streamline the automation, excuse me, the administrative part, and then also tie in your compliance tool all inside our platform. So now it's a retention of assets, a reduction of the administrative and compliance burden associated with these smaller accounts. So now it gives you the ability to kind of streamline all of it and serve any account balance size. And the last part, which goes back to tying in the prospect for the wealth side. So we have coined the phrase on our side of Next Level IRA serves as a gap IRA, right? It's that very specific segment, 7 to 100 grand, that again historically most advisors aren't targeting because it falls underneath that wealth minimum. Well, the one part we know is that if we can help you do a couple things that these individuals would turn into traditional wealth clients for you. So we wanted to build a long-term prospecting pipeline as the advisor for your traditional wealth business. With that, the way it kind of works, and we understand there's kind of two mechanisms here. One is let's use a $50,000 rollover as the example. Well, that balance is going to grow over time through performance in the market and also just through ongoing contributions, right? And at some point, that 50 turns into close to 100 grand, and you can use that individual and monitor their account. And when it gets close, you could reach out to them and go, "Hey, Wes, I was reviewing your account today, and based on your assets." I think we need to have a bigger conversation about some long-term planning. And if it makes sense for that individual, you can pull them off Next Level IRA and ultimately bring them onto your traditional wealth management services. The other part that we feel is that, again, a greater opportunity here is during enrollment, we actually capture outside assets. We do that during enrollment, and we also do it through, or you would have the ability to do it through ongoing educational pieces through our platform if they don't provide it during enrollment for those assets. So now a $50,000 rollover, if they provide that information, now very quickly could turn into 150, 200 grand, 300 grand that reside outside the plan. You never knew about it because they never took a meeting with you. And the only way you uncover it is by manual discovery. You have to reach out to them, get a call, and then have that meeting. Well, we try to actively capture that data for you, and then you have full visibility in the account. So let's say, again, a $50,000 rollover occurs. We identify it during the enrollment process. They have another 200 grand sitting outside the plan. If it makes sense right then and there, you can reach out to the individual because these are your clients. Have a good conversation with them, and again, if it makes sense, you can go ahead and roll them out of the platform. Then we have no time limit on our system or on our solution. So whether they're with us for 3 months or for 10 years, it's completely up to you. These are your clients. We're just providing you the platform and the administration to be able to again serve all account balance size. So I'm going to move forward on this part. And I covered a lot of these pieces already in terms of retention of assets, and more so how we're trying to streamline the process and reduce that administrative burden. Well, the communication to the individuals is going to be automated once what we call a campaign is started. So part of your administrative work, the part that we can't get around, at least right now, is access to plan and participant data, nor should we. We don't have access to your plans. We don't have access to the participant information, nor should we. Those are your clients. Those are your plans. So you would actually help us in terms of capturing the participant data we need to at least trigger the initial communication process. 3 simple data points. We need basically their first name, last name, and their email address. And when you capture that information for the individuals you want to prospect for specifically this platform, you would just upload it into your advisor portal that we provide you, and it triggers an email campaign that goes out to them. The messaging that gets extended, you have complete control over. So we would work with your compliance team to make sure the language is kosher and it fits exactly what they want it to say. And it's all housed. You have multiple templates you can use, again, that are all approved and have autonomy with your compliance team to ensure we don't get anyone in trouble in that aspect. But again, you control the messaging. our typical approach when it comes to guiding our partners on what that message needs to say, all consultative in approach. So, hey, Wes, I see you've terminated from ABC 401k plan. I'm here as your plan advisor to guide you on what your options are. And then it tees up some benefit elections. So, enroll into Next Level IRA, roll over to another IRA or 401k plan, stay in the plan, or cash out. And then that email in the signature line, it comes from you as the advisor. So it's a message from you, from someone they know, someone they trust already, and it's just consulting them on their options. Once a campaign started, really you're hands off at that point for the most part. So what happens if someone doesn't take action? You actually can set up a regular cadence on follow-up messages. So like every 2 weeks or every 3 weeks or every 4 weeks, they get another email. And they keep getting these messages based on the frequency you set until they take action. That action could be one of two things. One could be they start the application for Next Level IRA, or they could opt out of marketing campaigns if they wanted to. But again, that communication is going to be automated, so it's off your plate. You don't have to worry about it once a campaign started. After the campaign is started, again, it triggers automated steps that on a beneficial standpoint for you as the advisor, we give you full visibility into every account that you've prospected or every prospective account that you've prospected through campaigns. You have full visibility into the status in which they're at. So if they've started the application, they haven't finished, you'll know it. If they've completed the application, but they're waiting for you to complete suitability, you'll know that status. If the IRA's been approved and the rollover's been documented, we'll know if we're just waiting for the funds to be transferred to PinCheck. So the important piece for you and a big differentiator in our platform is you know exactly where they are in the process. So if you need to nudge someone along because they've been somewhere too long, you're going to know exactly where they are and what information to guide them on to move them through it. The next part, and I'll touch on this, and I'm going to move on to the next part, which is just the investment piece. So like I mentioned earlier, there's kind of two different types of advisors. And again, just for the context today, it's best served in individual conversations if you want to learn more. But with that, we have managed advice built into the platform. So we have two different managed account providers that are on Next Level IRA. One is Stadion, the other one is PGIM RetireWell. Fully personalized managed accounts, run personalized asset allocations based on the demographic information that we know. They do quarterly and biannual potential rebalances. So the technology will automatically look at the account holder's account. And if there's a variant large enough there that triggers a rebalance or the need for a rebalance, it automatically happens. That could be they grow a year older. Let's say they link outside assets. So we are dealing with real-time balances residing outside the IRA, and they make a big contribution to it. And we know that number. Same concept. If it triggers a rebalance, it will. Every time a rebalance happens or on that quarterly check-in, they get a report sent to them with an update of their portfolio, whether that rebalance happened or not. So 4 times a year, they're getting communicated with from their advisor without you touching a button. And then you also have documentation, because I know that's part of SEC, documentation of all of those reports and that email communication for your records in the case that you needed to produce that. But with that, the investment side is really taken care of for you. So you're still doing work. Your work is oversight and managing outcomes now. So if someone's not doing contributions, you might send them a message going, hey, I was reviewing your account. You're not doing ongoing contributions. That's something you should consider, and then all the benefits of doing those contributions. When it comes to that convergence of wealth to retirement, everyone talks about it at conferences, and we really wanted to make sure that was built into our platform. I kind of already touched on it a little bit in terms of utilizing the data we give you visibility into to prospect for your traditional wealth book. We also are capturing not only the account holders' outside assets, the first time, if they list themselves as married, the first time they sign back into their account after they've completed enrollment, a pop-up window occurs, and it's actually asking for their spouse's outside assets as well. We've done that intentionally because we want to be able to not only utilize that assets and the way we invest them in the platform, but also we give you visibility into these accounts. So not only do you have the investor or the account holders outside assets, you also have the spouses. So now you have a household picture. So now that changes the dynamic again, potentially of what you can do for that family versus just the individual account holder. And again, you have visibility into all of it. So it allows you to really, really utilize and leverage the platform for multiple ways, ultimately to grow and scale your firm. And again, I can't reiterate it enough. These are your clients. You can use that data the way you best see fit based on your services and your prudent strategies. Oh, sorry. One last. Oh, sorry. Yeah, here it is. So The two-way prospecting pipeline, this is one part that is an enhancement coming. So we've already built in the mechanism to bridge the gap from retirement to wealth, but we want to try to do it in reverse order, especially for advisors that are trying to actively grow their 401k book and use wealth clients to do it. And the way we've managed this is by capturing one simple data point, which is job title. Most individuals move to a new job for one of two reasons, if not both. Increase in their income or a promotion in their professional field. In most cases, when you get one of them, you probably get the other one or vice versa. So, we track their income level. So if someone goes from 100 grand to $250,000, maybe that triggers something on your side that goes, hey, that's a different mechanism or a different data point for a wealth client. But also from the prospecting side, from a wealth client to retirement, if Wes moved into a principal position, a president position, an HR director position, some center of influence at that new job over that 401k plan, and you're not already the advisor on that plan, well, now you can reach out to your wealth client. Hey, Wes, I was looking at your account. Hey, based on your position at your company, I would love the opportunity to do a benchmark against your plan and see if you can earn that business that way. And again, you have visibility into all of this data points and you can use it as you see fit. But again, it's a pretty clever tool in the way you can use it and ultimately manage your clients from there and what you can offer them. The last part is just the IRA management. So we are the record keeper for the IRAs. We are the IRA administrator. We are the custodian to the assets, and then we settle and clear through Matrix. We have multiple ways we can partner with you as an advisor. So the way I typically conduct my conversations with our partner clients is first and foremost is just me getting an idea of how your firm works, the structure of your firm, what you're looking to solve for, and then really I can kind of craft a story about how you could or could not use Next Level IRA, whether it's a good fit or not, based on your goals and objectives. But with that, there's multiple ways. Again, I can't reiterate it enough. If you're a plan specialist only, there's a way that we can give you a leakage strategy that literally no one's ever had a conversation with you about, with the exception of starting wealth. We can have a retention strategy without you starting wealth management. So if that's not something you want to do, we have a process in place that can do it. We've worked with, PRI as one of our kind of consultants on the platform and got some guidance from them to make sure that everything is kosher in terms of the new regs, whether it's Reg BI or PT 2020-02. And we would walk you and your compliance team all through the process to make sure everyone's very comfortable with it. You would have the ability to set your own discretionary advisory fees and really dictate the type of revenue you would want to earn off of the platform. The last part is everything is digital enrollment, digital in terms of management of the IRA. Everything's done online. You can complete enrollment once the fund remittance has occurred in less than 5 minutes, depending on the level of engagement they really operate on in terms of the information they're providing or maybe how much attention they're paying to it. The last part is, again, going back to the administrative burden aspect. So when it comes to service and support, and this is my last point, and then I'll wrap up for any questions. So PinChex has a dedicated team for Next Level IRA that we call our CX team. Our CX team is client experience, and we will field every service and support question for your account holders on your behalf. That would be, I'm locked out of my account. I want to do a distribution. I want to make contributions. I can't figure out how to do it. Even if they called you as the advisor, you would direct them to our team, and we will field those phone calls and manage that service for you. Anything investment related, we will point them back to you as the advisor. We won't field those phone calls. But again, it alleviates that administrative work and that customer service support off of your team so you can focus on other areas of your firm and we manage it for you. So I'm going to pause there and just let any questions come in that might arise.
I don't see any questions.
Okay, well, I know I'm running a little early. All right, so just because you mentioned it, I'll just mention one other piece
Sure.
that ties directly into Next Level IRA. So we're experts. I mentioned it earlier. We're experts in plan terminations. So if you and an advisor have whether it's one plan termination a year or you have multiple, or you've experienced one in the past, plan terminations can be painful. We've been doing this for a long time, and the process in which we conduct the plan termination is that technically your plan sponsor would hire us to manage the distribution and notice process. So what happens on the front end is you would work with your TPA to get all the compliance testing done and get the plan ready to close. So compliance testing is completed, determination date has been set, so you know when the plan's closing out. And once those steps are complete, that's where PinCheck steps in. And what happens then is, again, plan sponsor would technically hire us. So we'd have a service agreement with them, or if you have authorized signature, you could actually execute if you wanted to. And from there, we lean on our advisor partner to provide us the plan and participant data for everyone inside the plan. We have that uploaded into our portal for that specific plan. And then after that, we do a ancillary trust-to-trust transfer of the assets over to PinCheck's custodial platform. Why that terminology is really important. It's not a distribution. The plans remain in the assets remain in the plan. We're just changing where the assets are held currently. So again, it's an ancillary trust-to-trust transfer. The moment we get the assets, then we send out all the benefit election notices. We send out all the notices and the benefit election packets of how to claim their assets. It's really important that the trust to trust asset, or excuse me, the trust to trust transfer of those assets. Why that's important to this process, because it allows us to process the distribution for those individuals who do engage and do step forward to claim their money. So assets come to us, we send the notices out. Typically, it's like 2 30-day notices, one being certified mail, so 60 days to take action. Any individual that takes action, steps forward, they have a benefit election portal. They do it online. They can process their benefit election and have whatever they decide to do, that money is then transferred within 24 hours. After the 60-day notice period ends, then anyone that has been non-responsive during the notice period automatically gets moved into our Force Out IRA program. And what that means is, depending on the notice period, anywhere from 60 to 90 days, all assets have been distributed. The plan has all assets out of it, and the TPA then can step back in and execute the last 5,500, and the plan is closed in anywhere from 60 to 90 days. To tie back in Next Level IRA, if you're using Next Level IRA as a voluntary IRA platform within your firm, we can actually put your version of Next Level IRA as one of the 3 benefit elections in that plan term. So in most cases, you have like 2 or 3 clients in that plan termination you want as wealth clients, like your traditional wealth clients, and you can go after them in the way you do it today. Well, everyone else in that plan, we can actually help you retain them where you're not doing a lot of manual work. It's actually just offered inside the platform or benefit election portal during that plan termination process. So it's really unique. To my knowledge, no one offers this level of integration between force outs, plan terminations, and a voluntary IRA product, where we can really link all 3 to help you retain as many clients as possible, and then obviously build some long-term clients through Next Level IRA as well. So if there's no questions, I know I wrapped up a little early. I started early. Courtney is excellent. I've known her for many years from Pac Life, and I know she gave me some extra time. So if there's no questions, I'll turn it back over to Ari. And again, Ari, thank you for having us on the call today and part of your conference.
Not a problem. It's really, I think, one of the best tools out there. The involuntary cash out to me is one of those provisions that plan sponsors don't take a value of. They merely, wait until the plan is terminating, and then they got to put the money, send the money out. But, like I said, I'm glad that we don't have, I come from the dark ages of when we did have missing participants. We just did 100% withholding and be done with them. And, thanks to the Department of Labor in the last, 15 years of, guidance, we don't have that draconian provision anymore. And I think what PinCheck is doing is just fantastic.
Well, I appreciate it. Ari, are you able to, if I send you the deck, can you send it out to the attendees? Is that something you're going to do, or something you'd like
Or
me to do?
actually, it's probably easier if you give out your email address, and if they want to reach out and, probably deal with them directly, because obviously they have interest. They're going to have interest in signing up their clients for this.
Perfect. I'm putting in the chat right now for everyone. All right, perfect. Awesome. Great shot there, Ari. I appreciate it. Thank you all again for the opportunity, and I hope everyone has a great day.
Not a problem.
Thank you, sir.
Our next presenter isn't here yet, so I'm just going to talk. I'm very good at that. Again, that 401ksite.com, further information on all our events. Chicago is going to be in April. I can't believe that that's about 2.5 months away. Wrigley Field is going to be a great opportunity. There's nothing better in terms of ballparks. To me, it's Fenway and then Wrigley and then maybe Citi Field because I'm partial to the Mets. It's a fantastic event, 9 to 2. We break for lunch. We bring in the athlete. We do a stadium tour. And for those who want to stay the extra day or whatnot, I'll probably have some tickets to the Mets games. And that will also hold for Colorado in Denver on Tuesday, May the 5th. And eventually we will get to Washington, D.C. and sponsor that event in late September, I want to say. That will be something that I have to book shortly. And that's kind of like for me personally, that's kind of like I won't say it's like a homecoming, but it's kind of like a return because I went to law school in DC, and we'll see how that goes as well. And again, like I said, the books are available on Amazon.com. People are going to get tired of me talking about it, but that 401k plan provider handbook, which I will talk about at 2:30, that's about my presentation and some tidbits along the way. And I see that Lincoln is here. Lincoln, are you there?
I'm here.
Okay. Lincoln is from Blue Ridge Associates. They're going to be sponsors of our Denver event. And Lincoln, my events, we always go. For some reason, we end early. Most events, people can't stop talking, and it's always like late. I used to go to those events where people, you give them 30 minutes and they're 45 minutes, they're just finishing up. So feel free to use your 30. I might go 35, 40, but don't feel that you have to go quick.
Perfect. Thank you. So I'll go ahead and pull up my screen. There we go. Larry, thank you very much. We'll go ahead and get started. So first of all, great to have everybody. Thank you for the opportunity. Wanted to come up with some ideas for everybody to be able to share with their clients at the end of the year. And the reason I wanted to bring this up is because this is the most important time of the year for business owners. And it's, it used to be in the old days, it's like everything had to be done before December 31st. And if you didn't do it, you were kind of stuck with whatever happened. But now with the Secure Act, now we're in a situation that with business owners, they're doing everything they possibly can to make these financial decisions before the end of the year to reduce that taxation to keep more of those dollars. So we wanted to come up with some ideas that you could utilize to help your clients for 2025, because now with the Secure Act, you have up until you file your corporate taxes, but then also do some planning to get prepared for 2026. So with that in mind, there we go. With that in mind, wanted to just kind of get you thinking about your clientele and why you're going to have different types of conversations and what's going to be most important with them. So first of all, the thing I would look at is who is your client or who are your clients? If you're on the employee benefit side, you probably have a ton of business owners. And if you're on the wealth management side, you're going to have a number of business owners. And your job is to really protect their risk. Your job is to make sure that they're going to be in a strong financial position when it's time to be done working. Now, the thing I want you to think about, baby boomers. If you're having a conversation about what's going on at the end of the year, you've got these individuals that are anywhere from now really 61 to 80. These people own 51% of the businesses in this country. And what's crazy is when you look at it, even at that age, as you'd expect, you've got a lot of them, they want to be done. They look at what their life's going to be. And typically on the baby boomer side, their life has been, I'm going to work and until I can't work anymore. But you still have, just based on the age, and this is that whole silver tsunami deal, you've got 77% of those business owners that want to exit their company in the next 10 years. 57% of those are going to be done in the next 5. But now let's go for the younger group. You've got millennials and even going to the Gen X, where you've got people that are anywhere from, let's just call it 40s and 50s. 43% of those individuals want to leave their company. They want to exit in the next 5 years. When you run into that situation, I'm sorry, 48%. When you run into that situation, when you think about it, why is this important to you as an advisor? Well, if you've got a large benefits practice, if you've got close to 50% of your clients, assuming your clientele is like the demographics of the entire rest of the country, what happens to your business if you potentially have 50% of your business owners exiting? Can you afford to lose 50% of those clients in the next 5 years? Or what about 70 or 75% of those clients over the course of the next 10 years? The other thing, you've worked with these people for a long time, whether it's from a personal planning standpoint, whether it's an employee benefit standpoint, you've got quite the relationship. One of the biggest concerns is if people are going to be done in the next 5 years, or they're going to be done in the next 10 years, have they done the proper planning along the way to be on track for a financially secure retirement? So we're their advisors. You're their consultant. What can you do to help support this? One of the things that jumps out to me is if you've got people that want to be done in the next 5 years, if you're a baby boomer, only 15% of those individuals, those business owners, have a written company transition plan. Does that mean that 85% of the companies are just going to shut down? And if so, what happens to the employees? Or you think about the millennial side, you've got more and more of them thinking, question is, who are they going to? Who are they working with? Interestingly, when it comes to exit strategy, it used to be that people went to the attorneys and the CPAs. Those were their 2 primary consultants. That has now changed. Now, and that was back in 2013. If we take a look at the last report that came out in 2023, financial advisor is the most important person. So you've got people that have a need. Some have financial plans, some of them don't. Some are prepared. Some of them, they want to be out. But the question is, are they personally ready to leave? Is the business ready to leave? From a financial standpoint, are they ready to leave? So let's talk about conversations. This is something that I would love for you to think about when you talk to every one of these clients at the end of the year. And this could be the client, this could be with their CPA, this could be a management group. The one thing that comes up time after time is taxes. Now, there's 2 pieces of it. Part of that is the corporate income tax side. From a corporate tax standpoint, and this goes back to when taxes changed under the first Trump administration, every employer got a 20% reduction on their corporate taxes. However, they came with an asterisk. That asterisk is if you were a pure pass-through corporation, so an S-corp or an LLC, you had to qualify with the qualified business income qualification. Essentially, for last year, it was $494,000. I'll just use $500,000 as an easy number. If you made over $500,000, you get your 20% reduction. Now, realistically, there's a gap. At $494,000, you don't get any reduction in taxes. Or if you want the full reduction, you had to be below $394,000. So what can you do to help your client reduce their taxes by 20%? And think about this from a CPA standpoint. Anybody that's had a great year, the CPA says, hey, great, fantastic, you owe $500,000 in taxes. And that's it. That's the end of the conversation. You keep waiting for but. Well, what if you could help that CPA come back to a client and say, hey, you know what? We're in a scenario, you owe $500,000 in taxes. However, we've got some ideas to help reduce that. Part of that's the 20%, making a contribution, for example, going from $500,000 of income down to $400,000 of income. That can save you 20%. That's massive. Or we take it one step further. When you think about it from a personal standpoint, what if we could help you save up to $200,000 a year personally in income taxes? And most important, if you've got a massive taxable situation now that you just found out for last year, if you haven't filed your corporate taxes, you can go back and make these contributions to your personal retirement plan, and it's going to help you reduce your taxes tremendously. You will find situations that people have profit sharing and they thought it was skewed and they're putting away the 72 grand. That's great, but depending on the state you're in, that's only $30,000, maybe $35,000 in tax reduction. What we're looking at is if you're saving $30,000 to $35,000 in taxes, would you be interested in bumping that all the way up to a couple $100,000 a year? Now, how does this work? Well, it's an ERISA benefit. The government will provide you tax benefits if you provide benefits to your staff. But, there's a lot of folks that say, hey, I love to give charity, I love to give money away, but if I'm getting a 35, 40% tax break, if I get to give $100,000, let's say, for example, to a charity to save $35,000 in taxes, that still costs me net $65,000. What we're able to do with these retirement plans is set this up to where literally you might put $100,000 in your personal retirement account, you own it, you keep it, and it's going to save you $35,000 or $40,000 in taxes, but you still own all those assets. What we're looking at is going back to if you've got clients that are going to be done in the next 5 to 10 years, and if they have not put away the appropriate amount, if you can help them save $400,000 a year. Think about a client that says, I want to be done in 5 years, I want to be done in 10 years. You can put up to $3.5 million plus into a cash balance plan, so your personal pension. Add in the profit sharing component, you can provide a solution for a client that knows they're dramatically underfunded, where they can put away $4.34 million, and the government's going to fund close to $2 million of that with tax savings. So huge discussion to have with a client. 1, can we reduce your corporate taxes? 2, can we reduce your personal income taxes? And 3, can we get you on track for retirement? Going back to the personal taxes, one thing I would look at is a lot of people think, wow, how am I going to come up with the money to fund my retirement? Well, if you've got a tax liability, what if you took what you were already going to give the government, but let's take those dollars and let's reallocate that to your retirement account. Let's give some of that money to the employees, and whatever's left over, give that to the government. So think about that. This is huge. And if people haven't had this conversation either with you or maybe it's a prospect and they've got some other advisor or a CPA that's not helping them, huge opportunity. Now you're going to go through other things. Are you paying yourself the appropriate W-2 income? What are you paying yourself in K-1? Is your spouse working? Would you like to be able to take some of the money out of the company and put it into your own personal account? And if you do that, would you like to protect that from creditors? What about should you be doing future tax-free income versus taking immediate tax savings now? Or employees are important. For example, when you think about selling your company, if you don't have the right management team in place, all of a sudden you become a lot less valuable. What do you have to do to keep your key people around? Retention's huge. Or what about you have certain key people, certain key employees that you want to provide additional benefits to? Now, a lot of us have heard this. There's a lot of servicing issues that are out there in the industry. What kind of issues are they having? And this really comes to a head at going through kind of like the end of January into February, where people have to go through their year-end discrimination testing. They haven't done it in 12 months. They've got nobody to speak to. What kind of support can you provide? And then the last one, and this is probably one of the most important, goes back to that 5-year, 10-year deal. What is the plan for exiting your business? I mean, it's inevitable. And I'm not saying that somebody is, that you're old and you got to get out. I mean, we're seeing this with 40-year-olds. We're seeing this with 50-year-olds. If you're like most other employers, most other business owners, you are eventually going to leave your business. So these are some ideas that I would love to have everybody bring up when they're talking to their clients, because boy, does it make a big difference. Now, how do you become an invaluable advisor to your client? Every year, Fidelity puts out a big study, if you haven't seen that. A lot of this stuff I grabbed from Exit Planning Institute. When you look at what employers are looking for, their expectation of you as the advisor is pretty high. They expect a solid, reliable service partner. They want proactive consulting, not them calling and coming up with the ideas. They expect you to come out and consult on tax savings and wealth creation. They want expertise in the investments, not just the initial design, but what about the ongoing maintenance and the monitoring? Participant education. If you're going to invest this money in the employee benefits, how do you make it work? And the term education, to me, I don't really understand what that means. What I see is people want financial wellness. They want financial planning. They want to be told, what do I need to do? How do I invest? Am I on track? What should I be saving? Now, they want you to run the due diligence on their plan, vendor relationship management. If the servicing's not quite what was acquired or purchased years ago, they want somebody to step in and provide that relationship, that manage that between the record keeper, the TPA, their other professionals. They expect you to step in. They want help on the guidance, fiduciary wise. They don't want the risk. They want help with the governance and support because it does seem to change every year. We've seen this with Secure 2.0. Well, Secure 2.0, and we'll see what comes up next. You want to make sure the plan's working. And again, it's 68% of employers have already done the research, are already looking at the exit strategy. They want support. And again, they expect that from their financial advisor. Now, how do you build a retirement consulting team? When I say that, record keepers can do so much from a service standpoint. Some TPAs can do a certain amount. Some CPAs can do a certain amount. How do you really truly provide a team that's going to be able to support your client from a consulting standpoint? Well, one, provide a dedicated consultant. This world now where people are using AI, and even though it's smart AI and it sounds great, you can never really truly get an answer or a solution to your problem. Call centers, or a lot of the stuff's been outsourced to foreign countries, which when you think about that, from the information that's going back and forth is pretty confidential. That could be an issue. Proactive and timely consulting. They want financial planning solutions. They want advanced retirement plans that are set up to benefit the owners because they've taken all the risk. And again, so many of them are so far behind in where they need to be. This is the support you bring to the table. What about solutions for immediate business and tax relief? You think about that from both the corporate standpoint as well as an individual standpoint. Expertise and availability to talk to the CPA. The CPA should be involved in every one of these financial decisions. Bring them in because that's what's going to make everybody else comfortable. Showcase your investment management services. And last, make sure that you provide that planning team that needs to be both on the personal side, needs to be on the business side, and really we need to throw on the financial side as well. Well, why can we do this? So we're an institutionally operated TPA. We've got over 400 employees. Everybody's based here in the country. We've got a lot of clients, about 13,000 clients, over 1 million participants. You're going to have support on the advisor side, both on the sales side as well as the ongoing servicing. Every client gets a dedicated consultant. They're capped at about 70 clients each. Biggest thing people are looking for nowadays, can I go to the same person? Will they answer the phone? And will they get me an answer or a solution to my issue or my question? That's huge. We know technology is a big deal. For example, we got a SOC 2, which is important also on the security, and you need expertise. We've got clients, you've got clients. It can be owner only. And there's a lot of stuff they're looking at. Can I do a mega back to a Roth? Or if I own my company, can I also do a cash balance? Because maybe I don't have a company that's sellable. I got to put away as much money as I possibly can now because it's more of a lifestyle business. The company's paying for my lifestyle. 401k plans, pension plans, cash balance plans, ESOP, I think is a big part of it. You want a service team and you know exactly what that's going to look like. Now, let's talk about a consulting process. If we're going to look at building a financial plan, and really, it doesn't matter if we're talking about the education on a retirement plan or probably more important, you've got massive needs for a business owner. Thing I want you to think about is how long is it going to be before they plan on retiring? Have you had the discussion with them on how much income is needed? I mean, that's a big part of it. If you make $500,000 now to be financially secure in the future, I bet you they need $500,000 in the future. Let's just call it 400,000. I need $400,000. Do you know then what your number is? That number is how much money do you need to have in your account to where you could do a 4% drawdown without exhausting your account. A $400,000 income, and this is a number that's difficult for a lot of people to swallow. That's $10 million. So the question is, what do you currently have put away in your retirement savings, and what do you have in other investments? That's your wealth gap. That's what we've got to figure out. How can we help you fix that wealth gap? And hopefully you can sell your company, which might be able to fund it. If not, we need to come up with some contingency plans. Well, so when we sit down with the CPA, we need to start a planning process. First of all, what's your current income? What's W-2 and what's K-1? W-2 income can be used for retirement plan purposes. K-1 cannot. Is your spouse on? What about family members? What's current tax liability? Can we do things to reduce your corporate and your personal taxes to help you fund your retirement? Have you qualified for the QBI deduction? What steps are you doing to minimize profits? A lot of companies, they'll go out and they'll just buy stuff. Problem is, when you go out and buy stuff, a lot of that is going to be an appreciating asset. Versus what about putting some of those dollars into an appreciating asset that's going to be safe and secure from creditors that you know you can get to it again in the future? Are you taking advantage of all the government tax savings with your retirement plan that are available? A lot of people say, I max out. Okay, what does that mean? Are you putting away $17,000 into a simple? Are you doing the $24,500 into a 401k plan? Are you doing the $72,000 into a profit share? Or is it $300,000 to $400,000 that you could put into your own personal pension based on your age and your income? Well, making that decision can help you reduce your taxes. You can look at things like after tax to figure out if you want to reduce all those taxes in the future. It's also going to help you when it comes to figuring out the best way to transition out of the business. If you're thinking about leaving, do you want to reallocate some of those assets out? You try to protect you from creditors. Do you need to keep certain key people around for the transition to work? Do you want to provide this business so it's going to your kids or maybe a management buyout? There's so many different options that are out there. Real quick, I wanted to show you that QBI. This is that example where you can reduce the income, and this isn't next up every year, but for last year, if you can reduce that income down to that $394,000 level, you can see what a deduction that provides, which is massive. Plus, whatever you put in the retirement account, those are dollars that are not going to be taxed. If we look at, and this is a great piece, I implore you, everybody keep something like this with you. Every conversation with a business owner, every conversation with a high income client, use this with your CPAs. Based on the age, how much money can you save? Now, save, the question is, are you talking about putting away from a retirement account, or are you talking about from a tax standpoint? It's both. I mean, you take a look at a 55-year-old, and if you could save $160,000 in taxes while putting or contributing $357,000 to your retirement, would that be beneficial? And I bet you'll be amazed at how many clients have not heard this before. I mentioned earlier contingency. Let's say we need $8 million put away for retirement. And let's say between what you got put away in retirement and other investments, not your business, but other investments in that $2 million, what are you going to do to come up with that $6 million shortfall, that wealth gap? Well, you can save in a 401k plan. And when people say, I'm going to max out my 401k, well, $24,500 a year, plus your match, plus your catch up, plus your super catch up, if you're getting close to that retirement age, that's $480,000 you could put away in 10 years. You need 6. 480 is probably not going to cut it. You can do profit sharing. 815,000 sounds great, but again, if you need 6,000, it's a pretty small percentage. Now, when we do it, I would always suggest reviewing to find out, from a budgetability standpoint, how can we max out what the owner gets? Let's determine what the minimum amount is that you have to give your staff. A lot of employers will come back and say, no, I need to give my people more. Or we look at the market and employer contributions are X. Well, you can always give the employees more, but we want to help the employer figure out, rather than giving all this money to the government in taxes, what can you get? What can you give your staff? And are you still better off than you would have been otherwise by giving all that money to the government? Cash balance. Take these savings to a whole new level. You can save potentially up to $400,000 a year. Right now, the cap is 3.55 million, and that is index that will go up. But it's a great way for high income people with good, consistent income to put away a significant amount. I like the profit sharing. Let's maximize what you're giving to those key people. Figure out what you need to get the staff. It's a huge benefit for everybody. You still get it tied to a vesting schedule, which helps retain your talent, but it's going to help you get on track to where you need to be. So we looked at the simple IRA, the 401k, the profit sharing, the cash balance. None of those got you anywhere close. But if you take a look at that combining the cash balance and the profit sharing, that 4.3 million, if your goal was 6, you come up with a great contingency because you got that much closer. Now, what about when it comes to exiting the business? A lot of options that are out there, and none of them are 100% right, none of them are 100% wrong. It just depends on, what is the client looking for? Is the company ready to sell? Is the business owner ready to sell? Does the business owner want to stick around for a while? Do they want to pass it on to the kids? Is it a legacy issue? You can either at the end just shut the doors. And again, there's a lot of businesses. There's only about 20% of companies are actually sellable, which is amazing. So a lot of them kind of go through that close and liquidation of the assets. You can sell to an outsider, family members, employees, management. You could gift out stock to people, family limited partnership, working your way all the way down, even into the ESOP side. So I'm not going to go too in depth on it, just from a timing standpoint. But one of the options, and this works out to be about 10% of the exits tend to go ESOP. And I think we're starting to pick up a lot more of this. The government, the Small Business Administration, has come up with funds for employers to make this more attractive. And the reason why they've done that is because when you take a look at employee ownership, it allows the tide to rise. It's not just the business owner that's benefiting, but everybody benefits. Well, why is ESOP an option? Well, first of all, you get fair market value. So you don't have to go out to an auction. You get fair market value for what the company is going to be worth. It provides a buyer. We had a client, they only had one other competitor. So when they put the company up for sale, they got an offer of $6.5 million. Whereas when we went through fair market value, it was actually worth $17.5 million. So you provide a buyer at fair market value. One of the biggest things for an employer, when you sell a company, you owe taxes. Unless, if you're an ESOP, you are literally able to indefinitely defer the capital gains taxes. So let me rephrase that. You sell a company, and if it goes the ESOP route, because you're providing, the company is going to the employees, the government will literally allow you to sell the company without paying taxes. Now, there's some cool things too that I didn't even list on here. If you've got real estate, you have the ability to roll the real estate into the ESOP transaction and not pay taxes on the gains. Most places around the country, we've seen buildings that you bought for $1 million and they're worth $5 or $10 million now. If you can roll that entire business into the ESOP, you don't have to pay taxes. Or oftentimes, every business has had depreciation on investments. That depreciation, you've got to catch up eventually. It's 25%. You can roll that into the ESOP as well. So there's a lot of tax benefits to the client. And again, you're getting fair market value. Now, it's neat. You get to choose your successor. You get to protect the employees. The company is still in business. You get to stay in control as long as desired. You don't have to do 100% ESOP. you got to do at least 30%, but maybe you sell half the company. And then when you decide it's about time to be done, maybe you do another 20 or 30. You can get to 100 eventually, but you can stick around, you can still run the company, and you get to continue to select the management team. You leave behind a tax efficient company. And this is the neat one. What's great, and you see this all the time. People brag about how they are an ESOP owned company. An ESOP company, if it's an S Corp, the amount that's owned by the ESOP is tax free. And you think about that. Let's just think you're a big construction company and you're going out for a bid and you're competing with another firm. They pay taxes and you do not. You better win every one of those bids because your competitive advantage is massive. Now, the other thing that happens, you maintain confidentiality during the sale. Selling a company is tough. There's a lot that goes into it. You're typically, if you sell it to an outsider, it's going to cost you on the gross amount, at least 5 to 10% of the amount. You got to get your financials in order. The due diligence is going to be incredible. It's corporate culture. They're going to be looking at the finances. They're going to be looking at the organization. They're going to look at everything. And you still have to run your business. So knowing that a competitor is potentially looking at your books and your systems and your people and your profit margins and everything else, sometimes employers are a little bit nervous about making that available. Preserve your legacy. They spent their entire life building this company. Do they really want it to just disappear tomorrow? The other thing that's great is these people helped you build your business. They helped get the business owner to where they are. You are able to reward those employees that have contributed to your success. And what you will find is an ESOP company, because everybody has an ownership interest in the company, they tend to be more profitable. Now, last thing, of course, significantly increases the retirement accounts of your employees. So it truly is one heck of a benefit. So we can go a lot more in depth. I appreciate the time. I don't know, Ari, if we're opening this up to questions, but if anybody has anything, let me know.
There are no questions.
No questions? Okay. Well, I really appreciate the time today. So if there's anything else, reach out and let me know. And I look forward to seeing you in Denver here in a few months.
I appreciate it. And looking forward back to Denver. This time I'm actually going to drink more water. I was the first time I was out there in 2019. We had a great event, and that altitude really kicked my rear end for about a day.
Yes, it does.
So if people are going to join us in Denver, please drink accordingly, water preferably. Thanks so much, Lincoln. And let me get to my thing and hope people see it. But anyway, yes, I think people are seeing it. And this is Tales from the 401k Plan Provider Handbook, kind of my lessons, warnings, survival, and whatnot, just based on I can't believe it's 27 years experience already. It's more than half my life. Time is not passing me by. I've enjoyed almost every minute of it, and the minutes that I haven't enjoyed about it are probably in the book as well. And why this book is here. I wrote a book about 7 months ago based on my life story, like kind of lessons in life. And I appreciate for the 12 people that bought the book and business lessons that I learned. And I'm like, what kind of book am I going to write next? And I'm like, you know what? I should write about, plan providers and the mistakes that I've seen happen and the nonsense. I've seen a lot of firms, fail miserably or succeed quite well, and how simple as marketing mistakes can certainly, kill firms here and there. And providers, in my opinion, need kind of like advice, and unfiltered advice. I am the turd in the punch bowl. That's what I've always been saying. I said that in Disney, when we had the event. I'm not afraid to tell people when I think something's not really, really good. The 401k plan business is obviously a risk business. We deal so much with operational failures, the regulations, we have exposure. It's constantly changing. Cybersecurity threats are a bigger deal. In 1998, when I first started and people were making their deferrals, investment elections by paper or telephone, that wasn't such a problem. That wasn't something that we, thought would be a threat. And then when we started putting almost everything we do on the internet, and people could get hardship distributions and loans and all that stuff, that's when we finally realized that this could be a problem. And of course, there's a fiduciary creep where, plan providers are certainly doing things more appropriate for fiduciaries. And then as a result of their actions, they become a fiduciary. And obviously, marketing complacency. Training to me is really the first risk control. And when I worked at CBIZ Retirement Services Inc., back when it was actually before that, when it was Mobius Tech, as an attorney there, I used to joke that we got people right off the boat. And I'm not talking that and that's not some kind of anti-immigrant speech. My parents were immigrants. I'm first generation born in the United States. I'm saying that we took kids from my alma mater, Stony Brook, made them plan administrators, and gave them absolutely no guidance. So that's what I mean by right off the boat. They were math majors, and math, while numbers are really, really good and important for our testing, that doesn't make you a plan administrator. So most errors are training failures. And the problem is that if you were trained poorly from the beginning, you will continue to be poorly trained. I knew administrator when I worked at the Geller Group, and I'm no longer like playing with names. I'll mention you the firms. And she was somebody with 15, 20 years experience, and she was terrible because she never got the proper training from the beginning. Daily valuation is not clerical. And it's not just important that you have proper training, that you continue education. I'll never forget the administrator when I was at Geller Group telling me that, matching is on a 7-year schedule. When I told the guy, you know what? We changed that rule about 4 years ago. It's all 6-year graded as the maximum graded vesting schedule in a 401k plan for match. And smart firms are going to invest in people, not letting people, go across the street and find other work because we didn't give them a little bonus, or we cheaped them on, on a salary increase. The worst time of the year for me was my annual review. I'd rather go to the dentist. I'd rather go to, even worse than that, for me, the eye doctor. It just was not a pleasant experience because you were just told how well you were doing all year. And then when you had your review, you were told how awful you were, and that, that $10,000 increase that you were going to get, that you wanted, it was going to be $5,000. Processes, really protect firms. Important to have documented procedures, a segregation of duties, controls over the heroics, and systems over memory. I'll never forget helping a plan sponsor and advisor out by the end of the year and getting a nice little letter back from the advisor about what a great job I did. And of course, my boss had to not poo-poo what I did, but just said, oh, well, this is what we do at this firm. But, it's important to have proper processes in place. I also represent a school board yesterday, and I had their meeting, and it was just amazing. They did an audit of the academics, and it was just a horror show in terms of, a special needs school not having a literacy program or not doing any differentiation in education. It's important for any type of entity to be effective to have proper procedures and procedures that are actually followed. Fiduciary risk, accidental is still liability. Titles don't matter. I've seen mistakes happen from, the low level employees to the top. Function doesn't control status. Sometimes being helpful can be dangerous and could get you in, some areas of making mistakes. And it's important to stay contractually disciplined. Don't, as a lawyer, I don't do TPA work. I stick to what I know. I think as a TPA or an advisor, you should stick to what you know. A lot of people have gone and decided that they wanted to be more than what they were to their plan sponsor clients and ended up having to write checks for mistakes they didn't make. Insurance is a backstop. It's not really a strategy. Years ago, when I worked at CBIZ, one of the people who was processing the trades, daily trades, made an error, and Harvey Berman said, "Well, this is what E&O policies are for." That's not a strategy. you know, insurance coverage matters. Um, and, insurance does not prevent claims, and exclusions hurt. Just had a client just not inform their insurance carrier of a mistake they made. And that was a problem. And obviously, good behavior matters. Cybersecurity is right now not only a threat, it is also a positive marketing issue if you're ahead of the game. Sponsors obviously care about security. Breach really destroys trust, and money has been lost. Cyber readiness is a strong selling point to plan sponsors. Many plan providers are targets. Obviously, you could have people mimic plan participants. I've seen, outside of the retirement plan business, of people just falling for, simple errors. I have a Coinbase account. Constantly, well, first time in a while, I got the text how I should call this 188 number, what, because somebody in Baku, Azerbaijan, has, taken control of my Coinbase account. Now, if you know anything, Coinbase doesn't text you. Coinbase would call you. So I obviously told them to, in my Brooklyn, F off, and that was the end of it. But a lot of people fall for these things. It just happens because people are very, very trusting in nature. Documentation obviously is going to survive firms. Audits for plans, whether it's Brad with his CPA firm doing a plan audit, or dealing more importantly with a DOL IRS agent. Audits require records. You can't tell the IRS and DOL agent reviewing a case, by the way, we don't have it, and I actually have a client right now in that situation. Memory fails under pressure. Not everybody's taking ginkgo. Good documentation does limit exposure. Culture is obviously, in my opinion, a risk multiplier. Speed over accuracy creates exposure. Silence enables failure. And that's something that you see a lot when something goes wrong. Back in the old days of aviation, the first officer would never question the pilot. That's changed over time. I wish that was true a lot in the retirement plan space, where people aren't afraid to step up and say something in the firm is wrong, somebody made a mistake, and just not accepting of terrible behavior. And culture is really something that drives long-term survival. I have that in the school that, again, I was talking about the meeting last night that lasted almost to the end of that Ranger Islander game, which I don't really want to mention, but I just did. And, a lot of the stuff that goes on in that school is culture. It's been going on and on and on, and it's really hard to change. And I see that with, firms, and we'll certainly talk about one of the firms that's a big topic in the book. Marketing risk is a real thing. Firms fail quietly from irrelevance. Doing great work isn't enough. I think that marketing is all about reputation building. If it wasn't for my articles, you'd never knew I existed. I've took a lot of heat when I did that first TPA payroll provider article in 2010, but that's something that really generated and helped my business. I started in 2010. I want to say by 2012, maybe I was speaking at, Schwab Impact. If sponsors don't know you exist, you lose. And that's really, to me, such a big part of it. And the guys I was very friendly with at Brightscope, Mike Alford, who's now a whole Bitcoin trader and investor, he told me what set Brightscope up was talking about fees and whatnot in the LinkedIn groups when they were really functional and people interacted, and that really helped build their reputation and business. So talking about firms that are a big mess, the old Fakakta law firm that I always talk about, it was a dead culture. I saw it 16 years ago. Great firms can still die, because success breeds complacency. We've always been doing that way, so we will continue to do that way. And culture that stops evolving becomes obsolete. I was working for a managing attorney, and I wanted a national ERISA practice. And I first thought I could build it by getting referrals from our existing clientele, from the partners in the firm. The partners in the firm were made up of all these old sole proprietors, and they kind of held their client lists like it was the secret formula to Coke. But they didn't want to interact with me. So I said, you know what? I'll write articles. Advisors and TPAs will use my articles to refer me clients because I help them. And the managing attorney thought that this was like beneath us, that, the old days of referrals and meeting people at the Chamber of Commerce events and sponsoring this and sponsoring that were long over, in my opinion. Social media was away. And I figured 15, 16 years ago, this firm is going to die. And it's about less than half of the size that it was in 2010. Dirt culture really ruins plan providers. The same messaging for 20 years. They're doing the same events, the same brochures, clients moving on silently. I was a vice president of a synagogue in Rockville Center that was dying, and they would do the same things over and over again. We're still doing the same fundraiser for the high holidays, and we're still doing the same journal dinner. When I was a VP doing fundraising, I invited Sal, the stockbroker from the Howard Stern show, to do a comedy show at our synagogue. And we had 200 people show up, and about 175 were people that were not members of our synagogue. Because, you can't constantly hit the same people, and the new money of the people who are not members is just as good, if not better, than membership money. Clients move on silently if you don't do anything and don't market yourself and don't communicate. Marketing is risk mitigation. Visibility protects revenue. Education does build trust, and authority attracts better clients. And that's all about, marketing is about reputation building, getting your name out there, not overselling. If you look at my articles, it's always a call to action. It's not about how I'm the greatest ERISA attorney since Fred Reich, because I don't necessarily believe that. But, my articles is just a great conversation starter. And that got me to have conversations with plan providers who were using these articles to help get clients or retain their clients. I get it. 16 years later, still people talking about the payroll provider articles, whether they could use it or not. You help people out, you're going to get back as well. Sometimes there's marketing wrongs and, waiting for referrals only, not having any thought leadership, and fear of saying something wrong, which obviously it's not something I ever feared. I think I've said enough. I'm not invited to the nicer events anymore, I guess. So that's why I have my own. But speaking out and having an opinion will sometimes rub people the wrong way. But if you believe a certain way and your way is the right way, 16 years ago, I was one of the people who said, you know what? I think 401k plans should be transparent in their fees. If a plan sponsors fiduciary and they have to only pay reasonable costs, how could we fault them as fiduciaries if they don't know how much they're paying? That's not fair. And thankfully, the Department of Labor in 2012 gave us fee disclosure. And so I was one of those people getting attacked that somehow I was ruining the 401k industry because I was speaking out against kickbacks with rev share and whatnot. And I don't know anybody really using revenue sharing anymore. Thought, in my opinion, good articles is not advertising. Education beats promotion. Teaching builds credibility. Content reduces commoditization. The worst marketing, the worst networking I've ever seen is when people right off the bat want to sell you something. You get that LinkedIn stuff all the time. I don't. If you're in the business of helping law firms get leads and you want to connect with me, I'm sorry, I am not connecting with you. I know what you're trying to do. You're trying to sell me something I don't need. I'm all about building relationships. The worst advisors to me are the advisors who connect with me and then immediately want to manage my money. You're just going for the quick sale. You're going too fast. It's something I joke about dating, going too fast to the hoop. You're trying to score. And that's what people do when it comes to networking. Networking is like dating. It's trust. It takes time. Don't go too fast. Your story is a differentiator. Everyone offers administration or advisor work. Look to what other people are doing and be different. No one offers your experience or your take on things. And stories, in my opinion, resonate more than services. That's why I got 1,000 stories, and that's why I've written 4 books. I got a lot of stories. This book is full of a lot of stories and good, in my opinion, just good advice on how to run a practice. Content creates, interest. And, blogs create leads, books create authority, and speaking creates trust. Now, I've been blogging for 16 years now. Back at Meyer Swazi, I couldn't blog. I couldn't post anything on LinkedIn because the guy who wasn't even a partner and never drew a dime of business was part of the advertising committee of one, and he said LinkedIn was advertising. It's not if it's used effectively. Blogs create leads. I hired a marketing guy when I started my own practice, and he says it's going to take time for you to be in the Wall Street Journal. It's going to take time and trust. And I was paying him, I think, $1,000 a month. And I finally got rid of him because he didn't understand what I was trying to do. Within 2 months, I wrote a blog piece about 401ks and ETFs and 401k plans. I put it on Twitter. Needless to say, I was contacted by the Wall Street Journal, and I was interviewed and I was quoted. And it doesn't get you clients, by the way. It builds your reputation. It creates authority. Same thing with the books. Oh, wow, Ari Rosenbaum, he's written 4 books. Maybe I've sold like 100 copies between the 4 books, but it creates authority. It takes a bit to write a book. And speaking creates trust. And, I've spoken a lot over the years, not as recently as I'd like to, but it certainly helps you building trust with other plan providers and with plan sponsors. And why is this book a marketing tool? It positions you as an expert. It really starts conversations and it shortens sales cycles. Really, the parts on marketing and the explanation of what's interesting and what to write. Everything I do or write, it's really a call to action, getting plan sponsors and plan providers to do something. And by the way, if they ever need legal help, my name and number and website and email address is on the back of the article. That's it. And who's this book for? TPAs, record keepers, PEP sponsors, advisors, growing plan providers, or people who, I've talked to already 2 people in the past week going into the TPA business. I do wish them a lot of luck. That's what I can say. And what you will learn, how mistakes really happen, how people stumble, how to reduce your liability exposure, how to avoid fiduciary traps, and how to stay relevant in a changing business that's constantly consolidating. And, I've spent a lot of decades in the industry. It's hard to believe it's been 27 and a half years. I have the perspective of being a lawyer, so I know a thing or two about ERISA and the legalese and the legal aspects of what people do. Very few people, like me, know 2 plan providers who went to federal prison. Not something I'm proud of, but something that's an interesting tidbit because there are people in this business who do go wrong and think they could get away with it. But also reality on plan providers of what will work and what will not work. I was recently brought my attention, somebody, I think it was an ERISA attorney, doing a legal review for plan sponsors. He wants to charge the plan sponsors $5,000 a year. That's great. I've been doing a plan review for $750 for the last 16 years. I could count on 2 hands how many plan sponsors have done it because it's very hard to part plan sponsors away from their money. So the takeaway: risk is operational, risk is legal, risk is cultural, risk is marketing. And, my final thoughts: mistakes happen. Culture dies quietly. And a lot of times people don't want to change. And that's the biggest problem. Um, when you're stuck in your ways, that is the ultimate killer. And prepared firms are going to survive. We saw that with fee disclosure. A lot of people we know, a lot of providers we know, especially the insurance company providers that jettisoned and got out and sold their business, knew they could not compete in a fee disclosure environment. So they got out of it. They sold their blocks of business. They got out of space. And the firms that survived and thrived are the ones who were transparent in fees from the get-go, who didn't need fee disclosure regulations to tell them that they should be transparent in all their fees. Those are the ones that survived and did quite well. So again, the book is Tales from That 401k Plan Provider Handbook. Go to Amazon, type in my name, make sure it's spelled correctly, even though my first name is actually spelled incorrectly. It should be Ari, but my parents thought I was going to be confused, that people thought I was named after Aristotle Onassis, but that's that. And I think it's $9.99 for Kindle, $12.99 paperback, because learning the hard way is expensive. So for those that stayed on, we actually got questions. Mike Webb with the questions. What is your single funniest scene in the movie? Mine is the Sam Kinison scene in Back to School. That's funny. Speaking of Back to School, that is not in that book, that's not my favorite scene. Back to School. Back to School, my funniest scene is when he's in the bookstore and the son wants to get books that were used because they're already highlighted. And Thornton says, well, what happens if they were, if the kid who was highlighting was a maniac? My favorite, funniest scene in the movie, that's a tough one. I will always go to Airplane because that's my favorite movie of all time. The scene where they're telling Dr. Rumack we had a steak or fish, and Dr. Rumack says, "Yes, I remember I had lasagna." To me, is my favorite line. Um, and then, after that, so much of Caddyshack, anything that, Rodney Dangerfield said. I was just watching Mel Brooks special and thinking about all the stuff in Blazing Saddles. And so here's the other one. Ari, I look up to you as one of the best thought leaders on social media, not just in retirement, but period. Is there someone who you look up to as a thought leader? Not, not in the retirement plan space. But who do I look up to? I always find Darren Rovell very, very interesting. He's a guy who used to be on ESPN and CNBC, and he has some very interesting content. He rails against Bitcoin. I've always been interested in his feed. Got to meet him last year at Fanatics Fest. I look up to him. Um, I just got a signed puck from Mike Eruzione from the 80 hockey team today, Boston University puck. So I always look up to Mike Eruzione. But in business, I think that I'm a big fan of business history and Jeff Bezos and people like that who, obviously Robert Kraft recently. I'm fascinated by Robert Kraft. Robert Kraft, all those Super Bowls, and it was all started because of the 1984 Jackson Victory Tour. And if you don't understand that, look to Wikipedia and see how Robert Kraft engineered a pretty smart purchase of the New England Patriots, even though he overpaid for it. But yeah, that's probably it for me. But I've kept you all enough for today, and we start again tomorrow at 11. And Mike Webb will be part of the 401k virtual bunch at 12. And I appreciate everybody coming out. And again, I got that 401ksite.com, the books on Amazon and all that. So I will see you tomorrow. And if you missed any part of it, we might have it up on YouTube today, if not tomorrow. Take care. Thanks. Bye.